So then if you want to come back later for this information again, or if you want to share this with someone that you know, this will be on our website and you can access those recordings. So now, Frayne, I will pass the mic to you and you can take it away.
All right, thank you, Jenna. Yeah, I apologize for the adjustment in the schedule here, but NDSU decided to do a system update on some of the computers this morning, and Dave had to comply. So we're rearranging things and we'll make it work. Let me share my screen really quick and we'll jump right in. Just double checking, Jenna, you can see that okay? All right.
Yes.
Perfect. So good morning, everybody. My name is Frayne Olson. I'm the crop economist and marketing specialist with NDSU Extension. Here's my contact information. So if you do have any questions or things that you don't quite understand, if I'm not making myself perfectly clear, feel free to contact me either via email or phone. I would recommend my cell phone just because of travel and some of the things going on with COVID. I'm not always in my office, but please feel free to contact me if you do have any follow-up questions or want some additional information. So yesterday, I started out talking a little bit about marketing plans, the mechanics of marketing plans, and that setting these pricing objectives, which is really the first step you need to do in preparing a marketing plan, in my opinion, is really the most difficult. And so we spent a little bit of time talking about the different ways that you can try and set some of those expectations or set some pricing objectives. I'm going to review that quickly this morning, as well as give you a slight update. And then we're going to shift into choosing the correct marketing tool. So most of this is going to be talking about which tool do you use given what you think will happen next in the marketplace. As I said before, there's really three key pieces to setting the pricing objectives. First is know your cost of production. Now, obviously, there are times where you do have to sell your production below the cost of production, which is really unfortunate, but sometimes that's the best you can do. And your goal then is to try and minimize the loss. And again, depending upon the commodity we're talking about, is, you know, there are times where you can sell one particular crop for a profit and another one you might have to sell at a small loss. But again, you're trying to minimize losses. Another way of thinking about this is to look at the fundamental analysis. I'm going to go through some of the review very quickly, some of the things we talked about yesterday, bring up a few points that I want you to think about as we move forward in time. What are some of the things as we move forward that might have an impact on our fundamentals, both short-term and long-term? Okay, so yesterday I spent a lot of time on the supply-demand conditions. This is the information out of the USDA. I just want to review this really quickly and point out a few things and ask a few questions. All right, so the column on the far left-hand side is the information from the 2019 crop year. So it's the crop we harvested in 2019 and we marketed in 19 and 20. The middle column in the green is 2021. So that would be the crop we harvested last fall. We're now in the process of selling. And then 2021, 22. On the far right-hand side in blue is the current, at least the most recent forecast that USDA gave us in their outlook form. Now, a couple things that I want to emphasize. So if we drop down to the bottom line, the carryover stocks, the forecast, now this is a forecasted number. The number in black is an actual number based on some survey information. This bottom line in green is a forecasted number. And of course, over here on the bottom one in blue is definitely a forecasted number because we have very little information about 2021. Let's work backwards on this. So if we look at what USDA currently is thinking, kind of setting the stage for what the information we may get in that March 31 prospective plantings report. If we look at the bottom line, USDA is forecasting right now basically a slight uptick, very small increase in ending stocks. If we look at total use is about even with where we are right now. So again, some small changes by category, crushing versus exports versus residual. But basically, we're looking at the same type of year next year as we did this year. So if the demand base stays relatively stable, and we work the math backwards saying, well, if we hold our ending stocks about stable, we're looking at about a very similar kind of demand base in 2021. We work the numbers backwards. we're going to have to plant a minimum, not a minimum, we're going to have to plant approximately 90 million acres of soybeans and have a trend line yield to be able to break even, to be able to kind of have a push year. Okay, now when we look at the other crops, the other major commodities, corn, for example, again, the math works out very similar. We're looking at the very bottom line here. Our ending stocks are forecast to be relatively stable. There is a slight uptick in total consumption. Most of that is due to a rebuilding of the ethanol sector. We talked a little bit about that yesterday. Assuming that we have this kind of rebound or stabilization of the demand base of corn, and working the math backwards, we'd need to plant about 92 million acres of corn, and again have a trend line or slightly above trend line yield on corn, just to come out with the same bottom line, to have essentially the same supply demand conditions we have today. Looking at wheat, again, thinking about this competition for acres, we can afford to have some slippage in the ending stocks of wheat, because we right now have some pretty large carryovers in wheat supplies. Demand base is looking very similar. We work the numbers backwards. We need to have about 45 million acres worth of plantings. Now that would be all both winter wheat and spring wheat, and about a trend line yield to be able to have a slight reduction then in our total ending stocks. The moral of the story is we need to have this balance of acres, and right now both the futures market as well as the cash market is trying to make sure that we get this balance of acres between the major crops, corn, soybeans, and wheat. I showed this graphic yesterday just as a reminder. Historically, where have we been with the planted acres for the major crops? The gold line on top is corn, the green line is soybeans, the brown line is wheat, black line is cotton, and the purple is sorghum. And notice back here in 2017 and 18, both those years, we had about 90 million acres, plus or minus, of both corn and soybeans. We also had about that little bit higher than the 45 million acres that USDA is currently proposing for wheat. We had slightly higher cotton acres. Now, I don't expect cotton acres to reduce much. And sorghum acres, to be very honest, sorghum prices tend to follow corn very closely. So where do we come up with all these acres? Primarily, what I'm pointing to is primarily those prevent plant acres we had last year. So again, last year nationally, not just in North Dakota, but nationally, we had about 10 million acres of prevent plant. Our kind of a typical or average prevent plant is about 4 million acres from kind of a longer term standpoint. So we could easily pick up, given the dryness in particular in the Western Corn Belt, we could easily pick up, 5 to 6 million acres, just maybe 7 million acres, just in prevent plant acres coming back into production. So right now, the marketplace, the futures market in particular, is trying to signal to farmers, what's this balance of acres? Okay, now this is a graphic I prepared, and you may have heard about this corn-soybean ratio. So what is the market trying to signal to farmers between the two major crops being corn and soybeans? I know this is a really messy graph, and I don't want to spend a lot of time on it, but what I did was I took November soybeans divided by December corn futures. So these are the futures prices. This graphic is as of last night after the close. So I pulled these just for today. This is as of the close last night. So the red line right up here towards the top is the current ratio. So we're taking November soybeans divided by November 2021 soybeans divided by December 2021 futures. So what that ratio is signaling to us, if the ratio is in this top part of the graphic, there's a preference or the market is trying to bid for some more soybean acres. If it's on the bottom end of this graphic, then it's trying to encourage more corn plantings. Now, if you look at the red line where we are today, that corn-soybean ratio relative to this same time of year, the same time period in previous years. So I went back about 12 years, back to 2010 as this benchmark, as this reference point. I could have gone back further. I chose not to because kind of the current market and the market conditions we have today, if I go too far back, suddenly we're introducing some things that aren't really as relevant today as they were back then. The moral of the story is I want to point out two important things with this ratio. So notice as we begin kind of after harvest, looking a year forward, we have this range from the high end to the low end tends to be pretty wide. And as we get into this February and March timeframe, that ratio starts to narrow. So during this time frame, that ratio is trying to signal farmers what's the preference for planting. Now notice as we get to the end of March or the first part of April, something changes, something shifts. And after that change, all of a sudden it explodes and kind of does its own thing. That ratio does. Now again, we're talking about this ratio. Well, that is a signal. Guess what happens at the end of March? It's that March 31 prospective plantings report. So coming into that report, the futures market is trying to signal to farmers what balance should we have nationally between corn and soybeans. Once we get the information from the survey, USDA survey of what you intend to do as a farmer, then we use that number and things kind of go crazy after that. My point in saying this, right now, given that ratio, there's a very strong preference or signaling towards soybean acres relative to corn. The market is saying, look, we're much more concerned about having enough soybean production relative to corn. We need both, but we're trying to find that right balance. So as we move forward in time, it will be very interesting to see what happens to this ratio after that March 31 prospective plantings report. Now, if you follow the blue line and the green line, these two other kind of proxy years that look very similar to where we are right now, that ratio did drop, it did decrease after that report. And what that signals to me is the corn price relative to the soybean price readjusted. So they came back into more of a typical alignment. So we'll have to wait to see. It's just something to think about from a not only a fundamental standpoint, but trying to integrate some of this charting. One of the other things is we look forward in time. What are some of those things that might cause us some concern moving into the 2020 planting season? And as I've talked to farmers trying to decide what acreage to plant, and more importantly, how many bushels do I dare try and pre-price? About what percent of my production should I price ahead of planting versus mid-season versus waiting until after harvest? And I know I want to explain this really quickly because there's a lot of misunderstanding about how to interpret this drought monitor map. Now, it does provide information. It's something that both the cash market and the futures market follows very closely because it gives an indication of the sensitivity, kind of the volatility we might see in the marketplace throughout the summer months. So I want to explain this very carefully. We have different scales. If you notice down here, they got a D0, D1, D2. So what that means is this gold area, this yellow area right here, if that was in the middle of the growing season, what it's saying is that the drought or the dry layer in the soil is within the root zone. But if crops were growing today, they would be under stress, under water stress. It doesn't mean that they're going to have a yield reduction. It just means that they're stressed. We need some additional rain to be able to hold our yield potential. Now, as we move into these beiges and browns, what happens is that dry layer in the soil gets deeper and deeper and deeper. So they're using other indicators to say how severe is this drought. As the water layer in the soil gets deeper and deeper, what happens is you start having stock ponds going dry. As it gets into in particular the red areas, there's people that are concerned about the wells, not only water wells for human, but also wells for irrigation. And when you get into those dark maroon colors, that dry layer in the soil is extremely deep, and it can cause some really long-term issues for water use management. The point I'm trying to make is that this is really our buffer, our shock absorber. Just because it looks dry does not mean we're going to have lower yields. As you guys know, as farmers, if you get an inch of rain every week, even though you have no soil moisture, you can have a fantastic crop. And in some cases, because it's dry, you don't have the weed pressure. But what it also means is if you don't get those rain showers on a timely basis, if you miss something, if the rain shower just goes past you, hits your neighbor and not you, you have no soil moisture reserves to be able to draw on that. So you're going to start having some yield potential dropping. So what it really means is as we get into this Western Corn Belt, we get into what what typically classified as Western Corn Belt would be North Dakota, South Dakota, Nebraska, parts of Kansas. Iowa is considered part of the Western Corn Belt. Notice that we have Western Iowa is also in those dry conditions, but the Eastern Corn Belt is in better shape. Okay, what it means is the rainfall in this Western Corn Belt is going to be watched closely. And again, once we get an idea of what the planted acreage is, now we're going to shift all of our focus onto what's the yield potential. And that what I do anticipate is we're going to have a lot of volatility, both upwards and downwards during the growing season because of that uncertainty about yield potential throughout the summer months. Summer weather is always important, but I think this year it's going to be amplified because of the very tight stocks we have in soybeans, but also now the drier conditions showing up in this Western growing region. Why is that important? So I have this question periodically, and again, I'm trying to link what's going on in the supply-demand conditions with what's happening in the charts, because we're trying to pull this together to put some expectations in place for our marketing plan, saying, if this happens, what am I going to do? Okay, if we start getting a fantastic growing season and everything looks like it's going to be, you know, sunny and we're going to have lots of production around, what is my strategy? Versus what happens what will I do if there's a problem? What happens if the dry conditions continue, or we start getting a hot dry spell in the middle of summer? What is my strategy? If you think about it now and put the plan in place while you have time to think about it, instead of flying by the seat of your pants later on, I guarantee you're going to make some better decisions. One of the questions I'm getting right now and have been for a while is, so why aren't we seeing, given the very tight supply-demand conditions in soybeans, why aren't we seeing higher prices? Well, I wanted to put, this is what we call a continuation or continuous nearby soybean futures. So what we're looking at is the nearby futures contract. We're looking at it back in time. Now, each one of the little bars, remember yesterday I talked about each one of the little bars being 1 day. Now each of those little bars is 1 week, so we can look back further in time. So this is for nearby delivery. This is not a forward contracting for harvest delivery scenario. As of last night, the markets closed yesterday at about 14.25. So notice the blue on the far right-hand side. I drew in the red lines and the black lines. So let's compare today's prices relative to what we saw back here in 2011, 2012, and 2013. The question I'm getting a lot is, well, why, when will soybean futures hit $16 and $17 again? We saw it back in 2012. Well, I want to take you back in time and point out what kind of conditions led to that big price spike. And I'm going to focus on, for time, I'm just going to focus on this 11, 12, and 13 time frame. Now, given those 3 marketing years, kind of the midpoint, and this is why I tried to put those upper and lower bounds on what we saw during that time period, the midpoint of that is about $14 a bushel, which is really where we're right now for nearby futures. The question is, why did this spike? And if we were to look at it in more detail, we got planting progress, and by the time we got into first part of June, futures prices in 2012 had dropped to about below $13.50. Okay, now at about that time, the Corn Belt, in particular the Eastern Corn Belt, turned hot and dry. So the weather conditions in Iowa, Illinois, and Indiana suddenly shifted, and everybody started getting worried, and the forecast was for hot and dry weather. Well, that hot and dry weather continued not only through the middle of June, but into July and into the first part of August. So every day that we saw hot and dry conditions forecast in the Corn Belt, in particular the Eastern Corn Belt, soybean prices kept ratcheting higher and higher and higher. Corn prices did something similar. Then all of a sudden at the beginning of August, it was the first week in August, the rains came, the weather patterns shifted, and all of a sudden we started getting rainfall, it cooled off, and everybody started easing back and saying, oh, maybe we'll have an okay year after all. It's still going to be tight, but we don't have to ration so hard. And then by the time we got into harvest, by the time of harvest of 2012, we were back in this $14 a bushel range. And we stayed between about $13 and $15 for the next year and a half. And then all of a sudden in 2014, things started shifting. We rebuilt our inventories. We started getting enough acres, and people became more comfortable. My point in bringing this up is I do anticipate this summer we're going to have a lot of volatility in the soybean market. 20, 25-cent moves in the futures market is going to be common. So get ready, buckle up, get ready for this to happen. So what does that mean for your marketing plan? What does that mean for your strategy? Well, there's some other supply-demand conditions that I want you to think about, not only short-term, but a little bit longer term. The question is, how long will these higher prices really last? We are still hearing some issues about new African swine fever outbreaks in China. So even though, you know, the focus has been on COVID and what's happening on the human side, there's still some issues and problems in China with their African swine fever and the systems they have in place to be able to control that. So yes, they still have hogs that are dying, both breeding hogs as well as market hogs, but they're able to try and rebuild the system as quicker. They're able to add pigs faster than they're dying right now, which so net they are gaining, but that really doesn't mean that they have it completely under control. So please be watching. And again, if we think about what would take the market down very, very quickly, it would be another major outbreak of African swine fever in China. That would have a fundamental change in our demand relationships, and we would see a lot of money leave the marketplace in a hurry. So just because we're very optimistic now about prices doesn't mean that that can't shift and change. We do have some quality concerns out of the northern growing regions of Brazil, the soybean quality. So we need to think about, yes, Brazil is going to have a very large crop. They're going to have the bushels available, but what is the quality profile for that crop this year? The central and southern parts of Brazil, the quality is expected to be very good. The yields are expected to be very good. It's really just the northern portion, in particular that Mato Grosso region, that's having the most difficulty. We have seen an expansion, not only a rebounding in the swine herd, but also an expansion of some of the other poultry sectors, or poultry and a little bit of beef, aquaculture, dairy in the Chinese livestock industry. That is helping add to this demand base. What is the long-term expansion rate for this Chinese livestock sector? Because if we continue this for several years, for every action, there's a reaction. And economics is a lot like physics. So when we see this demand and higher prices, it has a buffering effect on the usage, but it also really kicks in and expands the production area. So there's already a few numbers that are starting to float around about the expansion potential out of the Brazilian plantings for 2022. They do have extra acres that they can bring into production. And again, how quickly can we produce the extra soybeans or corn relative to how quickly is the demand base growing? And that's a really big question. The other thing that I'm having my eyes on and watching pretty closely is this growth in the U.S. soybean crushing sector. We talked about it, touched a little bit on it yesterday. Most of that's been driven by biofuels, and in particular in some of the carbon policy in California. The real question is, what is this carbon policy on a national level? How quickly is that going to roll out? What is that going to look like? And how are the mechanics going to work? What are going to be the impacts, not only for ethanol, but also for biodiesel? So just a few things to help keep you awake at night and to worry about. So there's some real optimism, there's some opportunities, but there's also some things that could change that could cause prices to go lower. So we have to be watching both of those. On the technical analysis side, again, now we're going to get a little bit short term, a little shorter term, saying, all right, given what we see in the November soybean contract, the November 2021 soybeans, how aggressively should I start forward pricing? What are some pricing targets I should be putting in place for that 2021 crop? Because if you're going to expand your acreage based on the incentives you see in the marketplace today, those incentives can change very quickly. So if you're going to expand your acreage, my recommendation, I really want you to think about this, is you also should be thinking about locking in some of the prices you see today. It doesn't mean you have to lock in all of your crop. Doesn't mean you have to sell the whole thing. And I understand there's some hesitancy in being too far forward in your pricing, given the uncertainty with growing conditions and what your yield potential is. And I'll talk about that in just a minute. So we talked a little bit about the charting techniques. I'm not going to review that, but I did want to just take a really quick recap. Again, this is information as of last night, the close last night. What are these different indicators or signals telling us about the current outlook for 2021 soybeans? Okay, so the black line on top is the futures market looking back historically. This is the MACD, the moving average convergence divergence. Remember, Bill talked about that's probably the most of the single indicators we have, that's probably the most reliable one. It does look like that MACD is starting to turn a little bit lower. So we've been in an upward movement in prices. At a minimum, it looks like they're stabilizing, but it looks as though the momentum for November soybean prices is starting to turn a little bit. And I think part of that is because we aren't having a lot of new supportive information coming into the marketplace to help prop up those prices. Okay, so right now, using this indicator, it looks like it's either flat or slightly lower. If we look at this indicator, it's I'm drawing a blank. Relative strength index, RSI, relative strength index. Notice this indicator starting to tip a little bit lower, which is again another signal. This is a longer term moving one. It's a little bit slower to respond, but it's also signaling that we're looking at a slight reduction in that as we move forward in time. It's signaling that we may be tipping lower. If we look at just a simple trend line, we're starting to bump up against this trend line. So the next couple of days will determine, are we going to break through this trend line or not? Again, another indicator that we might be getting close to that downward tipping point in November soybean futures. We look at a moving average, which again is the black line on the blue line, which is a 20-day moving average. We're starting to touch that 20-day moving average, where it looks as though we're still in the upper range of normal, but it looks like we might be drifting lower. So there's multiple indicators now. We're kind of at that, looks like we might be at that tipping point for either a flattening out of futures prices or maybe even a slight downward tipping. Now the question is, well, if we do get a downward movement, if we do have some retracement, how far will that fall? Based on, again, very simple trend line and support and resistance analysis, it looks like about $12, a little over 12 bucks would be kind of that first testing point to say, well, is this just a slow drift lower, or is this something that is going to be a longer term trend? Now, based on last night's numbers versus that $12, that's still about 45 cents a bushel. So we need to be careful that we can see some price movement downward fairly quickly. So let's talk and shift into choosing the correct marketing tool. Okay, so we've set some expectations. I haven't gone through a lot of the timing objectives, but I do think that March 31 prospective plantings report is going to be our next kind of major shift or adjustment. We're going to hit the reset button on our expectations based on what we think farmers are going to plant. So do watch that time period very closely. Now, once you have those expectations, once you say, well, this is what I think is going to happen within the marketplace, or these are the things I'm going to be looking for. Now let's talk about choosing the right tool. And this is really where I wanted to spend most of my time today. So I've been talking about this for a few years. Some of you may have seen it, others may not. But this is a table that was put together by Dr. John Ferris, or Jake Ferris is his nickname. He was at Michigan State University. He's retired now, but he spent quite a few years putting this together. I think it's a really, really quick snapshot, a very quick way to try and decide, well, given what I think is going to happen, at least short term in the near term future, what strategy, what marketing tools do we have in our toolbox that might work best within these kinds of market conditions? And recognizing we have a lot of tools. Now, Dr. Bullock later on is going to come back and start talking about options as one of those tools that we have in our toolbox. Very powerful tool, but it doesn't work all the time. It works very well in certain market conditions and not so well in other market conditions. So the real question is, what are the things that we need to be looking at? And Dr. Ferris said, look, let's just focus on the two major things we need to think about that determines our local cash price. That would be the change in the futures price, which is this movement up or down. So if you think the futures market is going to be trending upwards, you look in the top half of this graphic. If you think the futures market has reached a peak and is going lower, you look at the bottom half of this graphic. The next question he said was, what do you think is going to happen to basis? And again, yesterday, Dr. Wilson spent a lot of time talking about this seasonality of basis, that especially in soybeans, that seasonal pattern of basis is pretty predictable, but it also has pretty significant impacts on the net price you receive. So if you think the basis is going to strengthen or become less negative, so if it's a really negative number, it becomes less negative, is strengthening. Or if the basis is going to weaken, meaning that we're already negative and it's going to become more negative as we move forward in time. So the real question is, on the basis side, when we look at the change, the rate of change in the futures market versus the rate of change in the cash market, which do we think is going to increase or decrease faster? So if you think the basis is going to strengthen, you look on the left-hand side to try and get an indicator. If you think the basis is going to weaken, you look on the right-hand side, right? And the reason I really like this is it has some implications for what I call cash-only marketers. It provides some guidance on when do futures positions or kind of futures-based contracts work and when do the options-based ones work. And it helps provide at least a little bit of insight in what your risk profile is going to be, as well as it tries to explain why certain marketing tools work really well one year and very poorly the next. Okay, so I'm going to kind of walk through this table really quickly. I'm going to look at different kinds of market conditions and try and explain why do these different strategies work or don't work, and then also emphasize what is your risk exposure. So there's always a level of risk that if you see a price in the marketplace, you want to try and lock that in. Depending upon how you try and implement that can significantly influence your risk exposure, okay, both from an upside as well as a downside. So let's just start in the upper left-hand corner. Upper left-hand corner, we're expecting the futures market to increase, okay, kind of a slow upward movement in futures market, but the cash market to increase more rapidly. So we're seeing an upward tick in the futures market with a strengthening of the basis. So it starts out really negative and becomes less negative. This is a common scenario, common condition that we see just after harvest. Typically, we see the lowest basis levels, the most negative basis levels, the weakest basis levels right at harvest, because the inflow of grain is so much faster than the outflow of grain. So the cash market is saying, wait a minute, slow it up. We're going to provide you an incentive to try and wait and deliver it later. Okay, now if you expect that basis to strengthen where the cash price is going to improve faster than the futures, one of the simplest things you can do is just basically store and wait, or price it with a forward delivery price. Try and capture the carry in the futures market if there is one. Now, we've got that one down. That's something that farmers are very, very good at. In this kind of market condition, the storing or wait to forward contract is a very good tool. It's a very good strategy. But as everybody knows, that doesn't always work. That's not always the best strategy given the market conditions. So now the next question is, well, okay, it's at harvest. I think and as Dr. Wilson said, basis improvement right after harvest in soybeans is fairly quick. Can we put it in the bin? Can we store it for a month, month and a half, and then turn it around and resell it at a higher price? Very possible. But what happens if you run out of storage space? What happens? You have a constraint. There's only so much storage space available on your farm. What are some other tools that might work? Well, another one is a delayed pricing contract, or a DP contract. Now, I know there's a lot of farmers, some of them really like this, some of them have been burnt on it. I know that in talking to some farmers, a DP contract is sometimes classified as a dumb producer contract. My argument is that a DP contract, delayed pricing, can be a valuable tool if used properly. And for those farmers that have used delayed pricing and been frustrated with it, my basic argument is, well, you're taking a really good tool, but you're using it incorrectly. So a delayed pricing contract, farmer delivers the grain today, but the cash price is not established. So you're delivering the grain, you're transferring ownership. You do not own that crop anymore. It's just you have sold it from a legal standpoint. You just have not established the price. You haven't determined either the futures price nor the basis. So everything is open. So essentially, if you transfer title, the person that has purchased it now can do what they need to with it to be able to move it through the system. Now, sometimes there's often a fee that's being charged for this, sometimes not, depends upon what's going on in your local marketplace. The challenge with delayed pricing is that you are considered an unsecured creditor. So if the person you're selling it to, if the company you're selling it to has financial troubles, they have title to your grain, you just haven't been paid. Now, legally, I just want to make sure everybody's clear on this. Legally, the grain dealer's bonding applies for the first 30 days of the contract. So in the first 30 days, there is some recourse, but you're not going to get your full money back. So it's the bonding of that particular agency or that particular company that will provide some financial support if there's a problem, if there's a financial problem at the company level. After 30 days, that actually gets changed to a credit sale contract. And there's an indemnity fund in North Dakota that's been set up so that if something happens after 30 days, at least again, you can get some partial coverage. So let's talk about delayed pricing contracts and misuse of that. Delayed pricing contracts were really intended to be a relatively short time period. And when I say a short time period, in my mind, I'm thinking within about 3 to 4 weeks. This is not intended to be a long-term marketing strategy. So if you do sign a delayed pricing contract and you're thinking about, oh, I'm going to wait 3 or 4 or 5 months before I try and lock this price in, you're going to be very, very frustrated. So think of delayed pricing contract as a short term. And what I'm saying, 3 to 4 weeks, don't, over a month, I start getting a little bit concerned about, so what is your marketing plan to start with? If it's a relatively short period of time, it can be a very, very useful tool. Okay, let's change the market conditions a little bit. So we think, yes, the futures market is going to increase, but the basis is going to weaken, which means that the futures market is going to increase faster than the cash market. So an example of this would be all of a sudden we get some like midsummer, okay? It looks like it's turning hot and dry in the middle of the Corn Belt. All of a sudden the futures market takes off and makes a massive run, but it's mainly because of that speculative influence where there's a lot of buyers coming into the marketplace. The cash market, the actual people buying and selling cash grain and saying, well, wait a minute, there's still a lot of growing season left. We'll follow the uptrend, but we're not going to follow it as quickly. Okay, so if we start getting a rally midsummer because of a weather problem, this is likely the case you'll see where the futures market increases quickly, but that basis level, the cash price will increase, but not as fast. So what are some of the tools in your toolbox that you can try and take advantage of this? Well, one of them is a basis contract. Now, again, some farmers have used basis contracts and they've been very pleased. Other farmers have used it and been very frustrated. So let's go through the mechanics really quickly. In a basis contract, what's happening is you're signing a contract for the delivery of a particular amount of grain to a particular location. So this is a cash delivery contract. The basis is fixed. So essentially what you're doing is you're coming back here and saying, I want to lock in this difference. And then as the futures market starts to increase and increase rapidly, I'm going to lock the futures market part of the contract in later. Okay, so we're locking in the basis piece. We let the futures market increase, and at the point where we think the price is high enough, again, it doesn't have to be the peak, it just has to be high enough to reach our trigger point, then we lock in the futures price at that point. And then from that, we take the futures price on the day you lock it in, we subtract the basis that's in the contract, and hopefully the effective price you receive in the cash market, actual cash check from the elevator or from the processor, is at a higher level. Now, the thing with that is the basis is going to be negotiated. Okay, so you've got to be, the basis is very time dependent. And so if you want to say, oh, I want today's basis for harvest delivery, and that harvest delivery is 6 or 8 months in the future, that will likely not happen. What you're going to have to do is talk to and negotiate the basis at the time of delivery, not the time period today. So you got to be a little bit careful of this timing differential. Okay, one other thing. Okay, I'll come back to that. Another possibility is either to sell the cash or forward contract to lock in both the cash price and the futures price, lock in both the net cash price, but then you sell the cash or forward contract, you buy back a futures market position. Now you do have to work with a broker to do that, but essentially what you're doing is you're locking in this cash price right here, and it's buy low, sell high. You're buying the futures contract, you're waiting for that rally to occur, and you resell it at a higher price. Now, a lot of farmers are looking at that saying, boy, that looks like a pretty risky venture. And it is, because futures market prices can change very, very quickly. Okay, so why does this strategy work? Again, I tried to explain that right now, or just previously. The question is this more risky than storing cash grain and waiting for a price increase? Or, again, just playing the cash market and waiting for prices to increase in the cash market? Well, indirectly, it can be more risky depending upon what happens to the basis, because if you do nothing, you're risking both variability in the futures market and the variability in the basis. Now, is it more risky than a basis fixed contract? So let's compare the sell cash buy futures to the basis contract I talked about before. And if you think that through, again, I don't have time to spend a lot of time on it right now, but if you think that through, it's actually the same risk exposure. Because by signing this basis contract, you're locking in the basis and you're waiting for that futures price to change. And if the price goes up, great, you've benefited. If the price goes down, now all of a sudden the effective cash price you're going to have would potentially be lower. There is a difference in cash flow, because if you sell the cash or forward contract, take a futures position, you are exposed to margin calls. If you do the basis contract, you still have that variability in the futures price, but you don't have to worry about the margin call, because the person that bought it, the company that purchased it, is responsible for the margin calls in a basis contract. Okay, what about selling cash and buying calls? Now, in a few minutes, Dr. Bullock is going to come in and talk about kind of the introduction to options. So by buying a call, what you're doing is, by purchasing a call, if prices increase, the value of that call will also increase. Okay, so you pay the premium, you buy the call, and what happens is, as futures market prices go up, the value of that premium will also increase. Now, it's not a one-for-one increase. So if we get a 50-cent rally in the futures, that rally or the increase in the premium for the option will be less. And again, Dr. Bullock will explain kind of why that happens. So this is very similar to the strategy we saw just a few minutes ago, where we sell cash or forward contract and then buy a futures contract. In this case, we're changing and buying a call. Now, the risk exposure for up and downward movement in the futures market is less for an option, but you still have to pay the premium and you have to be able to finance that purchase. Okay, so there's pros and cons to each one of these. None of these are perfect, but it just lays out some alternative strategies. Okay, so why does this strategy work? Because you're locking in the basis right here. You get your cash. You actually get, again, if it's stored grain, you get your cash. If it's forward contract, you've locked that price in. By buying a call, as the futures market goes up, the premium for that call increases, and you'll get some of the financial gain from that. Now, is this more or less risky than buy cash or sell cash, buy futures? Technically, it's less risky because you have less variability, because that options premium doesn't change one-to-one with the change in the underlying futures contract. So you're not going to gain as much if the price does increase, but you're also not going to lose as much if the price turns the opposite direction. All right, what happens now? Let's change the market conditions. Let's say we've had this great big rally in the middle of summer, and it looks like the futures market's turned over, and is now coming back down again. Oh, we got some rain in the Corn Belt. It looks like corn and soybean futures are starting to drop again. What are the strategies? The peak is already in. It looks like we're coming down. Well, again, futures price, the cash price will drop, but it's not going to drop likely as fast as the futures market. So our basis is going to strengthen. We've got a downward movement in futures. Basis is strengthening, becoming less negative. What are the strategies? Well, we can hedge. And what we're doing by hedging is we're selling futures here. So again, I talked before, buy low, sell high. Well, the futures market, we can sell high and then buy it back at a lower price. So if we sell a futures contract, don't do anything in the cash market. We sell the futures contract as the price of that, or the price in the futures market drops, we start gaining because we can repurchase that futures contract later on at a lower price, and we'll capture the gain from this price drop. Then later on, when we buy back that futures position, then we can sell the cash or forward contract and be able to lock in the cash piece. Okay. Now, some farmers would prefer to do a hedge to arrive contract. The advantage of the hedge is it's very flexible. Again, it works very well during like a mid-growing season because you can get into and out of these positions very quickly. It's a liquid market. But in a hedging position, you're working with a broker and you are exposed to margin calls. The hedge to arrive contract, it's a very similar process. What happens is you sign a contract for delivery with a local elevator. You lock in that futures price. So the futures price is locked in the contract. So you physically have to deliver the grain, but the futures price is locked in, but the basis is not. Okay, so what happens then is you lock in the futures price here, you let the futures price fall, that basis improve, strengthens, becomes less negative, and then at the time that you actually lock in the cash price, you determine what the basis is at that time, and you're able to get an effective higher cash price. Now, you are required to deliver. So on a hedge to arrive contract, you are required to deliver that grain. So if you have a production shortfall, you do have to notify the buyer and try and work with that buyer to say, okay, how do we deal with this shortfall? What are some of the remedies that we can have either as a buyer or seller to be able to work our way through this contract? And there's a lot of different ways that can be done. And it doesn't always mean that you're going to have to pay out a fee to have that transferred. It all depends upon what's going on in the marketplace. Okay. So the last option or the last choice in this scenario would be to, well, we could buy a put. And what happens with a put option, as the price in the futures market falls, the value of that option increases. So what I'm going to do is buy the put back here at a fixed premium. As the futures price falls, that premium is going to increase. But just like with a call option, the put option, that change in the futures market versus the change in the premium value is not one-to-one. The option price will not change penny for penny with the change in the futures market. So yes, it is less risky because if the market moves against you, you're not losing as much money as quickly. But it also means that if the movement is in the direction you expected, the gains are not going to be one-to-one. So there's a trade-off here. This is a really good strategy, but again, you have to have the financing in place to be able to buy that put option. All right, last scenario. We're almost finished here. Thanks for wading through this with me. I know this is going a little bit fast, but I want to give you kind of a snapshot of the different strategies that are available. The last one is probably the most difficult one. And from a timing standpoint, this is often what occurs as we move into harvest. So just a month or two before harvest begins, especially if it looks like we're going to have a great big crop, if the local crop is going to be very large, the national crop is going to be very large, we can see a downward movement in the futures market as well as the basis weaken. Okay, so the futures market is starting to drift lower. As we get closer into that harvest time period, the cash market starts to drop. Let's say we've got our bins full of last year's crop. We're saying, oh man, what do? Well, there aren't a lot of choices. This is the most difficult position to be in. Try and make the cash sales as quickly as possible. If it looks like that is the trend, guys, just get rid of it. Try and either you're going to have to get rid of it, or you're going to have to pay the storage cost to try and move into a different set of market conditions. So if the first would be just cash sales, get rid of it as soon as possible. If that's not available, again, let's say because of the timing of delivery or because of the flow of grain in your local market, you can also forward contract. Just try and lock that price in, the cash price, as quickly as possible, both the futures as well as the basis level. All right, so just to recap, and again, you'll get a copy of this presentation. I have kind of a cheat sheet where it's like a Word document or PDF of this graphic. If you are interested, please let me know and I can share that with you. I know some folks have printed that out, and one or two people I know have actually laminated it so they could have their cheat sheet right next to them as they're trying to make their marketing plans. My only caution as I'm wrapping up here is that all of these strategies assume that you have a relatively strong opinion about what's going to happen with prices. So again, you need to monitor what's going on in the marketplace, have that strategy in place, be thinking about these different tools in your toolbox, but as everybody knows, market conditions can change very quickly. So you do have to be worried about or be thinking about, well, what happens if these market conditions shift? How do I adjust my plan? The issue is it's a lot better to have a plan and tweak it than it is to not have a plan and say, oh, I'm just going to fly by the seat of my pants and hope for the best. Okay, to have a plan in place, I guarantee you will pay dividends. So following the trend line is relatively easy. The real hard part is trying to pick those corners. And again, when we look back at the technical analysis, those picking the corners is one of those tools that we have to be able to try and identify when does it look like some of the marketplace is forming some kind of a topping. Doesn't mean that it can't continue on later. It just means that within the next few weeks, it looks as though this is a price that will be the high water mark for a while. Again, a large part of marketing is risk management. So always be thinking about, well, if I do this, what kind of risk am I exposed to? What happens if prices go higher? What happens if prices go lower? And do I have the financial capacity to be able to manage that? So with that, I'm going to stop. I know I have a couple minutes left for Q&A. Jenna, I'm going to stop sharing my screen here, and we'll see if we can address some questions before Dr. Bullock takes over. Oh, you're muted, Jenna. I can't hear you. Try click it one more time. No. Now it says you're muted. Try unmute one more time, see if it clicks in. Nope. Okay, you work on your technical issues, and I see one question that came in the chat box. Do you have recommendations on what percentage of new crop should be priced at these levels? Oh, I was afraid that question would come up. And that's always difficult. So I want to come back to something I know Dr. Wilson and I have talked about this a few times. My predecessor, George Flaskrud, the guy that had my job before I took over, had a general rule of thumb. He said, look, if you're not really sure what to do, here's some kind of rule of thumb guidelines that seem to work pretty consistently over time. And he put it into 1/3, 1/3, 1/3. Okay, so in a typical year, now this might not be a typical year, but I just want to, as a starting point, 1/3, 1/3, 1/3. So about try and forward price about 1/3 of your expected production before planting. Okay, because there's often some real good opportunities at this time of year because the market is trying to incentivize, again, these planted acreage, this battle for acres. That's why I went into that. All right, now, and the odds of you getting, the probabilities of you getting across your whole farm 1/3 of your production is pretty high. So if you wanted to choose some kind of cash forward contract or actual cash sale, you know, that's pretty low risk, to be very honest with you. Then his recommendation was, well, okay, so once we get into the middle of the growing season, once we have a better idea of what our yield potential is and we see kind of what's going on nationally and internationally, then try and lock in about another third once we have a much better idea of what our, again, what our bushels are going to actually be. And then the last third, try and price after harvest. So you'll always have a few bushels that, depending upon what happens during the harvest conditions, what do you think is going to happen? And then you can use that last third. Now, Dr. Wilson actually had a graduate student kind of look into this and do some more formal math based on history. And he came up with numbers closer to 40% being pre-priced, priced before putting seed in the ground. But it did depend upon the year. Okay, and so the 1/3, 1/3, 1/3 to me makes a lot of sense. It's very simple to remember. It's very easy to understand. There are years, and the last couple have been a couple of those, or been a few of those, where that production risk seems to be lower than normal, and it looks as though we might have really, really big crops. So as we move through the summer, prices will be trending lower. To forward price a little heavier, to be further sold than a third, probably makes some sense. But again, he was trying to do something that would provide some guidance on something that would be a kind of a nice starting point. Now, depending upon your conditions and your appetite for risk and what you think is going to happen, obviously adjusting those up or down given those different time periods makes some sense. So hopefully that helps. Let me go to the Q&A function here. If you are on the wrong side of the futures, should you cash out or try to roll forward futures? I'm gonna cop out on you. This is the economist answer. It depends. So on the futures side, there's a couple different strategies. You can put in what they call sell stops, where if the market is moving against you, let's say buy low, sell high. So you bought a futures position and you were expecting prices to go upwards. You can also put in orders to saying, look, when I buy this, if the price falls to a particular level, just get me out. So you can limit your downside risk by putting in these buy stops or sell stops, depending upon your position. My personal bias, this is just me personally speaking, I would prefer just to cash out. So let's, we're willing to take some risk, we're willing to gamble, but I'm only willing to gamble so much. And if it looks as though the market's moving against me, my preference personally is to get out, take the loss, let's move on and try and recoup later. Now, there are farmers that will say, well, let's just roll this thing forward, that I want to allow some additional time for recovery in the market. And it really does depend, in my opinion, about whether that strategy will work or not. So my question would be, what fundamental change in the marketplace do you expect to happen in the future? If you're going to roll it forward, what do you think will happen in the future that would change the market viewpoint and the market attitude, saying we've got to push prices in the opposite direction? So it does depend. It depends upon the timeline, kind of what's going on right now. But most importantly, if prices are moving against you, I'm assuming they're going down, the question is, what do you think will change in the market to cause prices to go higher? What are the odds that that will actually happen? Another question. If you have a bearish opinion on soybeans, can buying a put be considered like buying an insurance premium if option is correct? Make money on options. If option is wrong, make money on a harvested soybean sales. Yes. So there's two different ways to think about using options. And I think the example that Dr. Bullock's going to go through is from a hedging position. Okay. You can also use options as a speculative position. But again, understand the difference. So if you're hedging, you're in both the cash market and the futures market at the same time. So you have opposite positions in the cash and the futures market. So if you're, for example, if you have grain in the bin, if you're grain in storage and you're really worried the prices are going to fall, you buy a put, because buying a put, the value of the put increases as prices decrease. Then that decrease in price, it'll hurt you on the cash side, but the option premium will increase, so you're getting an offset in the future side. So that's a hedge, where you're both in the cash and the futures at the same time. In the example I just went through, if you sell your cash position and buy a put, Now, all of a sudden, you've gone from speculating in the cash market to speculating in the futures market. And there is a difference. So you need to understand that differential. Okay, Jenna, I am 2 minutes over. Hopefully your microphone issues have been corrected.
Can you hear me now?
I can hear you now,
Okay,
yes.
good. You guys should see my setup. I have about 5 different monitors going right now. But one way or another, there's more than one way to figure this out. All right, well, thank you, Frayne, for being a Zoom pro and taking over those questions. Any
Not a
other
problem.
questions for Frayne before we move on to Dr. Bullock to talk about options?
So again, I'll be hanging on for the full session today. So if there are some questions that come in later, I'd be happy to try and answer them.
All right, thank you very much, Frayne. Okay, with that, Dr. Bullock, if you want to turn on your video and we'll start your share screen here. Dr. Bullock's going to cover options.
Okay.
So Dr. Bullock works with Frayne and Dr. Wilson at NDSU in the Department of Agribusiness and Applied Economics. He has experience in the grain trading industry prior to coming to NDSU. So with that, I will let you share your screen if you are able.
Yep.
Very good.
Thank you, Jenna. Sorry about the technical difficulties earlier. They decided to do an upgrade to my computer right before my presentation was to start here from IT. So anyhow, up and going here now. So I'm going to go through, this is going to be kind of an introduction to options. So kind of the assumption here is that you have had very little or no exposure to options before. And just an outline of what I'm going to cover. First of all, when we get into options, there's a lot of new terminology. If you've been involved with futures or cash markets, you know, the option market brings in a bunch of new terms. So we'll go through some of the terminology and basically to talk about the kind of the structure of an option contract. And we'll get into the payoff structure of puts and calls. As one of the questioners earlier, you know, asked a question and Frayne answered, you know, alluding to the fact that these are kind of like insurance tools compared to a forward pricing mechanism like futures. We'll talk a bit about the components of the option premium. Now, we won't get into the nitty-gritty details. One thing about option markets is that, like an insurance market, if you're familiar with an insurance markets, there's people called actuaries that do, they're very advanced statistical people. My daughter's an actuary actually with Transamerica. But you get into pricing options, it's a lot more complicated because we've introduced an insurance element. So we'll talk just kind of at a basic level of what are the components that go into an option, a premium. Then we'll talk about 2 basic strategies, buying puts to place a floor on a sales price. And then we'll look at, on the other side, if we're worried about a price increase, like for an input market, buying calls to place a ceiling on a purchase price. So a little terminology here. What is an option? An option basically is a financial contract that gives the holder, and by holder I mean the individual that's bought that contract, the right, but not the obligation to establish either a long buy position or a short sell position in an underlying market and at a fixed, what we call strike price. Now, highlight here, right, first of all, with futures, when you enter a futures contract, particularly a physically delivered like corn or soybeans, you basically have entered into an obligation, and that obligation is if you hold that contract all the way to maturity, you're going to be obligated to perform delivery or take delivery, depending upon whether you are long or short that contract. With options, the buyer or holder of that option has the right, an exercisable right, rather than an obligation. And that right, again, if they exercise it, is to get either a long or short position, and it's in this underlying market. And in this case, we're going to talk about options on futures. So the underlying market is actually the underlying futures contract. And the strike price is part of the contract specifications. It's fixed. So you get the position at a fixed strike price. So again, when I talk about a holder, just like an insurance policy, if you hold an insurance policy, you own the protection. of that policy. With an option, the holder has this right, exercisable right, that's granted by the option contract itself. Now, on the other side, options are just like futures in one aspect, and that is that there's what we call zero-sum market. For every long, there's a short. So for every buyer, there's a seller. These markets are designed to break even overall. So just like with the futures, for every dollar made, there's a dollar lost somewhere else. Same thing with options. It's a zero-sum market. So you have to have a grantor on the other side, and that's the individual that provides the right granted by the option. So the grantor would be a seller of an option. Holder would be somebody that's bought an option. Now, with options, we divide the market up into two directions. We got options for the downside, and these are called put options. So this grants the holder the right to get a short position. So this is a separate market, a separate contract. It's traded separately, but put option, right to sell in the underlying market. And then you also have contracts that are called call options, and call is a right to establish a long or buy position in the underlying market. So easy way to keep track of this is put option, you're putting commodities onto the market or selling. Call option, you're calling commodities off of the market or you're buying. Now I mentioned the strike price again. This is not a negotiable price itself. It's part of the contract specs. Now you'll be given a range, and we'll see this a little later when we go through price quotes on options. There's a range of strike prices available, but you pick an option, put or call, and you pick a strike price, and that strike price is the price at which you'll receive the underlying position upon exercise, irregardless of what the actual market is. You will get that guaranteed position at that strike price. Now, the one negotiable item on the contract, and this is if we don't have as much pit trading anymore, but one of my past jobs was working at the Minneapolis Grain Exchange many years ago, and where we trade spring wheat. And when I was there back in the early 90s, we still had pit trading and futures and pit trading and options. Well, in the option pit, what they're negotiating is the premium through open outcry. Same thing on the electronic auction markets of today. You're basically bidding or asking on the premium itself. That's the negotiable item, and that's the price paid by the holder to the grantor for that right that's contained in the option. So we mentioned exercise. So exercise is only the right of the holder, and they can decide to assume the underlying position granted by the option. The grantor, of course, will have to take the opposite side of that futures to make the market clear. So they're obligated if the holder exercises the option. Now, options have a fixed expiry date. This is a date by which the option must be exercised. Otherwise, it expires worthless to the holder. In physically delivered contracts, in other words, contracts where there's a physical delivery process where you have first notice day and so forth, typically the option is going to expire about a month prior to the futures. And the reason for that is that if we had option exercise occurring during the physical delivery process, it would really gum up the works on the physical delivery. So they try to get those option exercises out of the way before we get into physical delivery. Now, if it's a contract like milk, for example, it's class 3 milk, which is cash settled. It's not physically delivered. It's you settle the futures out at a cash value. Well, there is no physical delivery process. So exercise on those options can go all the way up to the expiration date of the futures. But again, with soybeans, keep in mind the expiry is going to be about a month prior to the underlying futures. And another thing to keep in mind is if that option, we'll talk a little bit later here about in the money, if that option is in the money, there may be a provision where that option typically is going to be automatically exercised, because the assumption is, you don't want to leave money on the table. If it's in the money at expiration, you should exercise it and take that money. Don't leave it on the table and let it expire worthless. But if it's out of the money, of course, you can let it expire worthless. Now, in terms of how you can exercise an option, there are what are known as European options. that it's an option that only can be exercised at the expiration date. So you hit the expiration date and decide then, do you exercise or not exercise? We don't have any options like this that trade in the US on commodities. There was one at one time at the Minneapolis Grain Exchange, and it was a European option that was traded on spring wheat. But that contract was not very successful, didn't get a lot of volume, so it eventually was delisted. But over in Europe, these are the common type of option. In the US, the American option, this option can be exercised at any time prior to expiry. So once you hold the option at any point, you can decide to exercise that option. Now again, the underlying market, this is where you receive your long or short position. Now I should point out, besides futures, options on futures, there are options on a variety of other financial instruments. You have options on stocks. Actually, they predate options on commodity futures. You have some cases where you have options that settle to a specific cash settled price index. And even you can even have options on a physical market itself. But we'll focus from here on options on futures, but there can be a variety of underlying markets. And you hear the term derivative or derivative instrument. And derivative, basically what we're saying is that these are financial instruments whose final payoff value is completely determined by what happens in another market, another financial market. So options are basically the final payoff on an option contract itself. You know, when you reach expiry, that final payoff value is determined by what happens in the underlying futures market. So we look at the payoff structure of put and call options. I'm going to do some additional terms here. One is we call what is known as in the money. So say you're a holder of an option, and and then you have the current, that option has a particular strike price to it. But out there in the market is the futures. And again, the strike price is part of the contract spec. The futures is what the market is actually trading at. So your option could be in the money. And by in the money, we mean if you exercised it right now and then immediately, took your futures position and immediately offset that futures. If you looked at the price difference, now this is ignoring the premium, it's ignoring the brokerage costs and all that, but is just looking at the price spread, you would make a profit if you exercise that option. So for puts, for example, it would be a case where the strike price is greater than the futures because it's a short position. So you get a short position at the strike price, and then you can turn right around and buy back at the lower futures price. Again, with a short, you make money if you can offset at a lower price. So you've made money off of that price difference. With calls, it'd be a case where the futures price is above the strike price. So with a call, you get a long position at the strike price and you can immediately offset at the higher futures price and make a profit off of that spread. Now, the other side of in the money is out of the money, and that is where if you exercise, you would be put into a losing position. Immediate offset, you'd have a loss. So just the flip side for puts would be cases where the futures exceeds the strike, and for calls would be a case where the strike exceeds the futures. Now, the reason we differentiate this, again, think about it, you're the holder, you have a right. Why would you take on a losing position when you don't have to? So out of the money options, we typically assume unless you're mentally off. Again, you could exercise an out of the money option, but why would you unless you're irrational or have some other motivation besides profit loss? But you will not exercise an out of the money option. Now at the money is basically that break even. That's the point where the strike is equal to the futures. Now oftentimes you'll hear the broker say at the money strike, and what he's referring to is a strike that's closest to the current futures. So sometimes at the money might refer to the strike price that's closest to the futures. We'll see a little later on option quotes here with DTN. They actually have on the screen we'll look at, they have a shaded area that shows what they call the at the money strike. It kind of, again, is a dividing line between in and out of the money. Now, with futures, it's pretty easy to offset a position, or there's only one alternative basically, and that is if you're short futures, if you initially sold, you buy back to offset. If you're long futures, you sell to offset. With options, it's a little bit more complicated, and so we'll look first of all from the holder's perspective. how can you offset potentially an option position? Well, first of all, because options are a zero-sum market, just like futures, you can turn right around and sell that same option. So in other words, the same underlying futures, okay, same, put or call. So, if you bought a put, you'd sell a put at the same strike price. So the same features. So you sell that option, the same option as what was originally purchased. And what you're hoping is to make a profit off of the appreciation and the premium. So if the premium increases, you make a profit. If the premium is declined, you would have a loss if you chose to offset. So profit loss here would be the current premium minus the premium you originally paid for the option. You could choose to exercise the option. And again, you'd only do this if the option is in the money. But you'd make a profit technically if the option is in the money enough to cover your original premium, because your original premium paid for the option is just like insurance, it's a sunk cost. So if the option is in the money enough to cover the original premium paid. I will say typically this will only be an option really for the holder in most cases if we're right at expiration or close to it. And that is because if you exercise the option, you give up any time value that's in that option premium or any extra value that we'll talk about in a little bit. If you sell that option or offset the first option, you get back both the time value that's in the premium and also the intrinsic value. So typically the first option is the most likely way you'll resolve the option position. The second one is more likely if you're holding it right up to expiration. Because as we'll see, time value goes to 0 as we approach expiration on an option. The third is that you let it expire worthless. And here you basically are just out the premium. Just like when you buy insurance and you don't need the insurance, you're just out the premium. You buy an auto policy for coming year, you don't have a car accident, you're just out the premium. So you can let it expire worthless. Now, these are all decisions by the holder. You'll notice they have control. They can choose to exercise. They can choose to offset. So all three, worthless basically, again, if you let it reach expiration and it's worthless. But you can see here the holder has control. Now with the grantor, you have the same. The only option he really has control over is the first one. And that is, again, you can short the premium. If you're the grantor, you've sold the option. You're technically short the premium. So you can turn right around and buy back the option. Again, it's a zero-sum market, so that offsets. And in this case, you're going to take that premium you originally received from selling the option and then subtract out the current premium you're going to have to pay to buy back that option and get out of the position. So again, you'll make money if the premium declines. The second option, you have no control over. You could be assigned exercise. Exercise, just like delivery, is a function handled by the exchange clearinghouse. So you could be assigned exercise by the clearinghouse. You have no control over that. And so if the option is out of the money, which is not likely if they're exercising it, again, they're not going to do it unless they have some crazy notion besides profit. But typically when you're assigned exercise, it usually means you're going to be in a losing position because the option is in the money. But again, it has to be in the money enough to basically completely wipe out the initial premium you receive. So again, you're starting out ahead and that you've received a premium. But, again, that loss there, is it enough there on that to completely erode the premium? It may not be. So even if it's in the money, you may still be at a net positive position. And the third option, again, you have no control over, which is expire worthless. So again, in this case, you get to keep the full premium, just like the insurance company. Somebody buys a car policy from you and they don't have an accident. Well, good, you get to keep the premium. You don't have to pay out any indemnities. Now note that the grantor's profit loss position is the exact opposite of the holder's. Again, this is indicative of the zero-sum nature of the option market. Just like the futures, these are zero-sum markets. So one of the things I like to do to illustrate how options work, or the mechanics, is use what's known as profit loss diagrams. So first of all, I'm going to illustrate the call option. And this diagram, we have profit and loss on the y-axis. So 0 means break even, below 0 is loss, above 0 is profit. And across the x-axis, we're looking at increasing the underlying futures price. And I will condition these by saying that this is basically what these profit losses would look like at expiration on the option. So these are purely linear. Now, prior to expiration, these diagrams become more curved a bit, because we have this risk premium built in addition to the intrinsic value. So this would be basically at expiration. So first of all, I'm going to divide up the price space here. So at the money is where so this is where our strike price is at. So at the money right here is where our strike price is, futures equal to strike. And then we have in the money for calls, anything above the strike price, and out of the money to the left. So first of all, here's the holder's position. And we have the grantor basically the exact opposite. So, basically this difference here, this flat difference, is basically equal to the premium. So when it finishes out of the money, like we said, the holder keeps the premium. Or excuse me, the holder is out the premium, the grantor gets to keep the premium. We didn't need the insurance. However, when it goes above, so, even though you're at a loss here, if you're the holder, it makes sense, if you're at expiration here and the option is in the money, it makes sense to exercise to at least whittle down that initial premium expense. So again, you'll exercise, and the same thing here, with the grantor. See, you're starting out at higher premium, but as it gets exercised, it gets whittled down. So this point here basically of intersection is the option break even, and that's basically the strike price plus the premium. These are 45-degree lines. Now again, here I'm ignoring brokerage costs, which is for grains typically 1 to 2 cents a bushel or so. But so here's your break even point. Now for a put option, things are just flipped around. So, out of the money is up to the top and in the money is below. Here's our strike price, our holder position, the grantor's position, again, the mirror opposite. And again, the distance here is the premium. So again, if it's finished is out of the money, grantor keeps the premium and the holder receives the premium. And as the price falls, you have basically a 1-to-1 increase in profit to the holder and a 1-to-1 increase in loss to the grantor. And again, the break even here would be basically the strike minus the premium. Now, one thing to notice here is, if you look at the grantor, their risk here, their risk is pretty much unlimited, both for puts and calls, because in the money, they have to basically pay out whatever the in the money amount is. And here it's going to be limited by, you can't feasibly hit 0, of course. But with the same, with the call options, again, the upside. But if you look at the holder, the most you can lose is the premium. But you have the potential, pretty much no limit on the gains here as it goes in the money. So we have an asymmetric risk payoff here, or risk profile between the holder and the grantor. So when we have that kind of asymmetry in terms of risk, there's going to have to be some additional compensation to the holder for the additional risks of taking on this position. And that's where we get into the components of the option premium. And the first component is basically just the current exercise value if it's in the money. We call this intrinsic value. So that's if we exercise and immediately offset the futures, the value we get back. So, or 0. Again, we don't assume out of the money is going to be exercised. So if it's at or out of the money, the intrinsic value we assume is 0. You're not going to exercise out of the money. So intrinsic value would be the in-the-money amount we exercise. But there's this additional insurance value, sometimes called time value, because time is one of the components, and it tends to be a fairly dominant component, particularly as we approach expiration. But this is the extra risk value compensation required by the grantor to compensate for the added risks of writing an option contract. Just like the insurance company has, when they write a premium, they factor in these risks in terms of making sure, that they're not going to lose money on the policy necessarily or be compensated for providing coverage on those risks. Now, there are three, unlike an insurance policy where the risks are tied to the specific individual. With the option, it's a policy on the market itself. So the risks are tied to the underlying market. And one of the primary factors is volatility. We always talk about volatility, variability as a measure of risk. It's one of the primary measures of risk and risk analysis. And so the higher the more volatile the market, the more wide the swings are in price, the greater the risk is in writing an option policy. And I want to point out here that the volatility we're concerned about here is really the forward volatility from now until expiration, not what's happened in the past. However, a lot of cases we'll look at the past again to forecast the future. So if it's been highly volatile in the market, it'll tend to indicate a higher forward-looking volatility based on but again, it's a forecast or what we think the volatility is going to be. So we have underlying price volatility. The other thing is the more time there is to expiry, the more time there is for the market to move, in a negative direction to the grantor. So the greater, just like when you think about if you wrote an insurance policy on your home and it only was for 1 day, versus a policy for 1 year, the 1 day policy would be a much smaller premium. The risk is, the odds of a damaging event, a fire or whatever in 1 day is much lower than the probability of an event happening over a 1 year time period. So again, time to expiry, the greater the time is, the greater the premium. And this kind of interacts again with volatility. Risk-free interest rate basically is in options on futures is basically just to convert the future value of that expiration, value payment back to present value. So it's really a time value of money thing more than anything else. And premiums, this tends to be the least of the three in terms of impact on the premium. Very little impact really on the premium from the interest rate. Now it's interesting, this volatility actually, you can take a market premium and work backwards through the options, one of the option valuation formula, and actually get a forecast of volatility. So the option market really provides, if you look at it from an informational perspective, the futures provides a forecast of what the market thinks the price will be at maturity. The option can give you a forecast of what the market thinks the variability or volatility is around that forecast, or kind of the standard error of the forecast. So it is, options provide some useful information to the marketplace, and it's called the implied volatility. So let's look at an example here and break down some premiums. So this is from DTN last week, May soybean options. And so you can see the strikes here. These are in cents per bushel. So the blue line here is the at-the-money strike here, which was $14.30. And you can see here over here, the futures price for that date, the closing futures was $14.33 3/4. So the closest strike to that futures was $14.30. And here's the call. So one side of the market here, the call market, and here's the puts. The price here is just the premium. So at the money here, these are in quarter cents here. So this is 48 1/4 cents, or 48 2/8. It also gives you the change from the previous day's close. And you can see for puts, it's about 44 1/2, so 4/8. Now what I'm going to do is break down these middle five here. So from 14.10 to basically 14.50. So I have the calls over here. I have these strikes. I've pulled in the premiums from these quotes. So for calls here, 57 1/2. 52 3/4, 48 1/4, 44, and then 40. Now with calls, we know that if the futures is above the strike, it's in the money. So from 1430 to 1410, we know that the option is in the money. And we take the difference here. So 1430, 375 minus 1430. So we have 3 3/4 cents intrinsic value. If we subtract that intrinsic from the premium, what's left over is basically that time, and volatility value, 44.5. Likewise, we go to the 1420 here, there's 13 3/4 cents. So we subtract that out, 39 cents. And the same thing here with the 1410, we're up to 33 or down to 33 3/4. Likewise, here it's out of the money, so the intrinsic value is 0. It's a max of 0 or the difference here. So all the premium is time value, 44 cents and 40 cents. And again, what this represents is, again, the odds, we know the price could move, above these levels. So, that represents the volatility in the market and the odds that prices could move up above those levels. What you'll notice though is when we do the time value, the highest value of time value is going to be at the money strike. And part of the reason for that is there's another measure of in options. We won't spend any time on it today, but it's called delta. Delta is basically the correlation between the option premium and the futures price. So the degree that, Frayne mentioned that the premium, prior to expiry won't move 1-to-1 necessarily with the futures. And so, but delta also represents the absolute value of delta, represents the probability the option will finish, expire in the money. And so if you look at the money, and if you have kind of a random walk view of the future, the delta on the option is going to be about 0.5. So it's a 50-50 proposition. Whereas if you get in the money, the delta is going to be above 0.5, the absolute value delta. So the odds of these options finishing in the money is even higher because the market really has to move a ways to get these out of the money. Whereas if you look at the out of the money, the delta is going to be less than 0.5. So basically, if you look at a 50-50 coin flip, that is about as risky as it can get. If you were going to do a bet on a coin flip, whereas, with a 75-25, if it's heads 75% of the time and tails 25% of the time, well, it's a little less risky. You can kind of figure out, do I want to take that bet or not, So again, a 50-50 proposition is the riskiest. So that's why we look at the money options, they're typically a delta of 0.5. And so that's typically the riskiest proposition looking forward. Now with puts here, you'll see we flipped the intrinsic here. They're out of the money from 1430 down to 1410. So intrinsic is 0. And then once we get up to 1440, now again, it's strike minus futures. So we see here 1440 minus 33 3/4. So we have 6.25 cents of intrinsic, and then 16 1/4 for the 1450. And so again, we break down the time value, and well, this is kind of interesting, and part of this is due to we're fairly close to expiration, but when we're at the money, there's something called put call parity, which basically says that the time value will be approximately the same, for the at the money. We can see here that we're basically the same for these other strikes, which again is what will happen as you get closer and closer. Now, if we were further out from expiry, we wouldn't necessarily see these time values the same for the out of the money and in the money strikes. So just breaking it down, hedging with options, and Frayne talked a bit about some of the strategies, on his grid. But when we're looking at hedging with options and comparing options to futures, we look at futures prices or futures contracts and using them as a hedge. We're just basically trying to forward price. We're trying to lock in a general price level. And with the hedge, we're exchanging cash price risk for basis risk. So the only variability in our position is really the change in the basis. Once we've place the futures hedge. So we're looking at the cash futures spread, but it's a forward pricing mechanism. With option contracts, we're looking at a price insurance mechanism. So hedgers pay a premium to place a floor using puts or a ceiling using calls on a particular price. We look at the grantor of the option, the one that's selling options, you're essentially providing price insurance. You're an insurance company. So they receive the premium, and in exchange, they must pay out any indemnity, intrinsic value that is on the contract. Now, a key thing here is, since, you remember back to those diagrams, those payoff diagrams, since the holder, the buyer of the option, the risk is limited downside to just a premium. Again, you buy the insurance, the most you can lose is the premium. And you've already paid that up front. That's paid up front on the contract. So you've paid out the maximum you could lose. So there's no risk of you defaulting on the contract. So there's no need to margin your position, nor have it mark to market daily. So with buyers of options, if you buy a put as a hedge or a call as a hedge, one of the advantages is you do not have to post margin. Now, we decide to mix that with a sell of an option, that's a different story, because the grantor's risk is not capped by the premium. So they do have to post margin and have their positions marked to market. And the way their positions are marked to market, there's a system called SPAN, which uses this delta, the correlation between the premium and the futures, and it converts your position into an equivalent futures position using delta. And that futures position is then margin, just as if it was a regular futures position. Now, one of the key factors in option hedging is choosing a strike price. You have a variety. We saw there was a big range of strike prices that are available. And again, the range available will kind of depend on the volatility in the market. So if the market's highly volatile, there'll be a much wider range of strike prices, and you'll see more liquidity even further out away from the at-the-money. And but if the market's not real volatile, then the distribution is going to be kind of more condensed, so you won't have as big a range. And again, volatility will kind of drive that range of strike prices that are available. And again, there'll be enough to cover basically the entire feasible future range of price scenarios. But choosing a strike price for an option hedge is like choosing a deductible on an insurance policy. So you're basically deciding how much loss you're going to take up front and then how much you're going to cover. If you choose an at-the-money option, you're basically taking a zero deductible. You're saying that versus at the current futures value, we're going to, basically have the policy absorb, pay out indemnities on any risk that falls below the current price. If we go out of the money, the further we go, the bigger the deductible. So we're saying the price has to move against us a certain degree before the option becomes in the money. So we're willing to absorb, the difference between the current, at the money or futures price and that strike price. We're willing to absorb that up front. Now, unlike insurance, you can have an inverse deductible. You can overinsure by going in the money strike, and typically hedgers do not buy in the money options because it's typically not a really very good deal at all, because you have an inverse deductible. You're overinsured. And you'll basically, the market will make you pay through the nose for doing so. So just like with regular insurance, the greater the deductible, now the lower the coverage, because you have to absorb a certain amount of the upfront loss, but also just like with insurance, if you take a deductible on your auto policy, your premium goes down because your risk of the policy is lower. You're willing to absorb at least a part of that first upfront loss. So again, choosing a strike price is like choosing a deductible on an insurance policy. It's a trade-off between how much coverage you want versus how much you're willing to pay up front in terms of the premium. So there's a direct trade-off between the level of coverage and the cost of the insurance with options. Now, how does basis factor into this? An option is a derivative instrument, so it inherits all the characteristics of the underlying futures contract market. So the basis risk that's with option hedging is the same basis risk that you face with futures. So when you're evaluating basis, for option hedging, you use, basically the same basis that you evaluate for a futures hedge. So basis on option and futures hedges is the same. Now we look at hedge costs on options. There's a brokerage fee that's associated with option. As with futures, the brokerage fees can vary from broker to broker. Depends on how much, how many services you want bundled with it and so forth. But brokerage on options typically is less than futures. Now, one of the things you'll often find with an option brokerage is there might be a half a brokerage fee when you enter the option position, and then another half when you exit the option position, either through exercise or offset. So there's kind of sometimes a half and half type of arrangement. But there's the brokerage fee is one of the components of cost. Now with futures hedging, the interest cost is basically tied to the margin you have tied up. You post initial margin, and that's money that's tied up. So there's an opportunity cost to tying up that money. With buying puts and calls, as I mentioned, there is no initial margin requirement. So you're not tying up any money. So if you're buying, typically any interest cost would be basically related to the fact, do you have to borrow to pay the premium? If you have to borrow to pay the premium, then there's some financing, and again, hedge costs are basically those extra costs incurred due to the decision to hedge. So now if you sell options, you're going to have to deposit margin. So there will be some interest on margin. Now, given interest rates the last few years, this is a very negligible cost. You're probably aware of futures hedging. It's typically less than a penny a bushel. But again, it can be there, but it depends on whether you're borrowing or posting the cash or whatever. So first strategy I want to look at is this buying puts to place a floor on a sale price. So in this case, we're looking at somebody has a long cash position. So you're either holding inventory of the soybeans, or you have a crop growing in the field, pre-harvest situation, but you're basically long cash. You're going to make money if the cash price increases, and you're going to lose money if the price falls. So let's say we buy a slightly out of the money put option. So I overlay the out of the money put. Now, when we add up these positions vertically, that gives us our net position here. So here we bought it slightly out of the money, so we're kind of at a loss on the cash. And also we have the premium paid, so we've kind of reduced our, if the price stays here at the out of the money, of course this is the current price, but we kind of add those up, so we're down here. But you'll see here from this point below, just like a futures hedge, the out of the money put, the intrinsic value directly one-to-one offsets the decline in the cash price. So what happens is we basically have flattened this out again. So we have basically a minimum price position here. The only thing that can cause this position to change is the basis. Again, there is basis risk. So, potentially it could shift up or down depending upon changes in the basis. If it strengthens, it'll shift up. If it weakens, it'll shift down a bit. So key thing when we evaluate a put option purchase is, just like with the futures, we want to calculate an expected hedge price. Futures plus basis minus hedge cost is the formula for a short hedge. And then futures plus basis plus hedge cost for a long hedge. With puts, we're going to calculate a expected floor price. So this is the minimum sale price, basically given your basis forecast is accurate. And it's established again by purchasing put options against the long cash position, as we showed in the position diagram. So it's similar to the hedge price. The formula for the expected floor price is taking the strike price, so instead of the futures. So we take the strike price, we add to it our basis forecast for the period when we plan on lifting the hedge, and then we subtract out the two costs, put premium and the hedge cost. And so this will give us sort of the expected minimum floor price based on our basis forecast. So I'm going to go through an example here. So again, going back to our March 8th, 2021, and say you're a producer and you like to examine buying puts for new crop soybeans and expect harvest around October 15th. So underlying futures is CME November 2021. And here's the price information. We have a futures price 12.54. Let's say we forecasted our basis as a $1.25 under. And our brokerage, let's say it's $70 a contract. I guess that's a little bit pricey. Typically, it's probably going to be more, it depends on the level of service. Again, you want advisory piece or whatever. But we'll just say $70 a contract, so we get a around penny a bushel for a brokerage cost. And since we're buying puts here, there's no other hedging costs involved, so that's 0. And then I want to look at the options. And so here's the 1260 is my at the money strike. And then we have our out of the money here, 1240 and 1220. And in the money, 1280 and 13. And here's the premiums quoted for those options on March 8th. So first of all, I want, just for comparison purposes, say we want to just do the futures hedge. So again, futures plus basis minus hedge costs. So we end up with 11.28 per bushel. So this is kind of the price we could expect to get if we put in a short futures hedge. And again, basis changes here as that basis. This is the one unknown in the equation right here that can vary. If it strengthens, the price goes up. If it weakens, the price goes down here. If we use the option hedge, it's strike plus basis minus premium minus cost. So I filled in the strike prices here and the premiums. And I get expected floor prices that range from 10.17.5 for the out of the money here. So I'm absorbing about 40 cents of the upfront risk. And I'm only paying 76, well, shouldn't say only, that's pretty expensive premium right there, but that's because volatility has been pretty high, 76.5. So 10.17.5. I go all the way up here to the end of the money, I'm up to 10.49.25. And I can tell you if we continued going up, further and further, we're not going to end up getting a floor price that exceeds the futures hedge price. And the reason for that, again, is we're paying that extra risk value in addition to the intrinsic. So we're not going to be able to get a level of protection as a floor that's equivalent to the futures hedge. What that tells me is if I'm very certain the price is going to fall, I'm going to lean more towards the futures than I am going to lean towards the put. Why would I lean towards the put though? If I think there's a pretty good chance that prices could move upwards in a favorable direction, then it may be better to have a little lower level of protection. Again, if this is above my break-even price and I can live with these floor prices, then again, given the basis risk here, because this could change a bit too, but if I can live with that, then maybe it's better to take that, have that upside advantage. And if I plot these out, so I have the underlying futures price here, and here's the net cash price that we receive. This is basically just if we didn't do anything. So if we speculate on the cash, we profit if it goes up, and we end up with a lower price as the price goes down. Here's the futures hedge right here. It's just flat. We don't participate in any upside opportunity, but we have a high level of protection on the downside. And then here are the various options. The brown dot here, this is the deep in the money. So again, we're still giving up quite a bit of extra premium here. And then down here is the higher deductible, the 1220. So, but you can see here, we participate in the upside market. So that's the put hedge. Now, if I look at buying calls to place a ceiling on a purchase price, in this case, we have a short cash position. We're looking at a future purchase. So maybe it's a purchase of feeder cattle for a feedlot, or some input that we're hedging. So short cash, and then I'm going to buy a slightly out of the money call. And again, if I add those up vertically, then here's my what I call my ceiling hedge, where I'm protected if the price goes up here. And again, basis can cause this to vary now because this is a long hedge, or the option equivalent of a long hedge. If the basis weakens, we pay a lower price, so we benefit. If the basis strengthens, we pay a higher price, so we don't benefit. Now, the ceiling price is the maximum purchase price given a basis forecast. And in this case, instead of subtracting the premium and hedge costs, we just take the strike plus the basis forecast and add the premium and the hedge cost to that, because they're adding to, this is a cost we're hedging rather than a price received. So go through an example here. Let's say last week, an importer of US soybeans, maybe they're based out of the P&W, and they have uncovered forward sale commitments for delivery at the P&W for the next month. And so we're looking to protect against an increase in the price. They've already committed on the sale side, so they have a price already fixed on the sale side. So they're open on the buy side here in terms of buying the soybeans to fulfill this contract. So the underlying futures is CBOT May 2021. So again, notice it's going to expire April 20th. So we're near April 20th. So we want to get it so that we're just past our date where we're going to offset. Price information, futures 14.33 3/4. Here we're out at the P&W, so the basis is a little bit stronger here, minus 25 cents a bushel. Brokerage is $50 a contract, so 1 cent a bushel. And again, they're just buying a call, so there's no interest cost or other hedging costs. And here's the strike prices. So at the money is 14.30, and then we go out. I'm in the 20-cent increments here. So here we're going further in the money here, 14.10, 13.90, and then further out of the money, 14.50, 14.70. So again, if I just do a long hedge, just for comparison, again, the formula for a long hedge is futures plus basis plus hedge cost. So I'm at 14.09 3/4. So again, given my basis forecast is accurate at 25 under, I can expect to pay about 14.10 per bushel. And again, if I use the option hedge, strike plus basis plus premium plus hedge cost, you can see my ceilings range, you know, out of the money here, all the way up to 14.79, and I can get her down to 14.34, you know, with the in the money strike here at 13.90. Again, you could go as far in the money as you want. You're never going to get a ceiling price that's going to be below or at the hedge price. The hedge price. So if I'm absolutely sure the price is going to go up, I'm going to choose the futures over the option. But again, if I want to participate in a decline in the market, I can use the call option to be able to participate in that position. And here's the position diagrams again, the underlying futures price change and then the net cash price paid. And again, you know, the higher the prices, the higher I pay in terms of the cash price. But again, you can see here, here's the futures. So I'm basically fixing, it doesn't participate in the downside of the market. And here's the various options. So again, the kind of the amount of premium you give up here versus the amount of coverage and participation in the market. So again, the options give you that opportunity to participate, you know, in the favorable price moves. But again, there needs to be a fairly good chance that you're going to see a favorable price move or a material chance of that occurring. Now, as with all marketing strategies, I highly recommend when you go through these and evaluate these, do a thorough scenario analysis, not only on the price, but also, we didn't do anything here on the basis, but look at basis scenarios. So a weak basis scenario, a expected basis, and a strong basis scenario. You know, do some spreadsheet what ifs to evaluate and see, are these prices that are there, are they prices that we can live with based on our cost of production, our break-even price, and our tolerance for risk. So that concludes my presentation. So I will open it up to any questions.
All right, thanks, Dave. I see one in the Q&A function, and there's some data to support, but the heart of the question is, why is there a huge percent premium difference when you compare the premium to the put strike price?
Why is there a big difference between the
So he gives an example. There's a put strike price of $13.60 with a premium of about $166. So that's about 12.18%. There's a put strike price of $12 with a premium of 63 cents, and that's about 5%. So he's wondering what's with the big difference in percent premium.
You know, again, that's going to depend. Let's see here. So you have a put of 1360. Let's see. Trying to think where the futures. That's in the money, right? On the put. Like I said, the volatility. The more in the money you get, yeah, the risk value. It has to do with the intrinsic value, I think, of the option.
Okay.
Because you're adding on that extra intrinsic value, and that adds on 1-to-1, whereas the time value is not a 1-to-1 correspondence with the premium. So when that option goes in the money, that premium is going to go up not only 1-to-1 with the futures price, but you have also that added time value. But the time value doesn't increase 1-to-1 with the price.
Okay.
So that's why percentage-wise, as you go in the money, the percentage of the premium relative to the price is going to go, strike price is going to go up. Whereas if you go out of the money, again, that you're basically looking at purely time value, and that time value declines as you go further out too. So that percentage is going to go down.
Okay. He also asks, what's strike price to optimize premium cost versus benefit?
That really depends on your risk preferences. Again, looking at your break-even price also, your cost of production, all that kind of ties in. But it's just like buying insurance. What coverage is good for you, in terms of an automobile policy or any other insurance? It's a trade-off between deductible that you're willing to absorb, how much deductible are you willing to absorb versus, how much coverage you want or how much premium you want to pay up front.
Okay.
The other thing that factors into this, and I see this a lot in corporate settings, but I think it applies also to farm settings, and that is, at some point, just like when you're buying insurance, there's going to be a budget limit in terms of how much you should be willing to pay for a premium. And a lot of cases, and this is where you kind of get in, we won't cover it today, but where you get into what we call fence strategy, where you're selling, putting a ceiling and a floor on a price, by writing options. If you're buying a put to set a floor, and then maybe you sell a call at a higher strike price to set a ceiling. What you're doing, the only advantage of that is really basically reducing the net cost. So maybe you want a floor and it's too expensive, so you want to try to put that net cost into your budget so you can sell a call. But what you're giving up then is you only participate up to that point with that call. So there are all these are all these trade-offs. And again, doing a thorough spreadsheet, scenario analysis, with these different options, I think is very important before making a final decision.
Sure. Any other questions for Dr. Bullock before? I did accidentally skip over everybody's break. So if we have some time, we will take a quick break before we have Sean on at 10:15. So we do have some time for a few more questions if there are any. I don't see any coming in. So All right, with that, if Dr. Bullock, are you around if something comes up over the break?
Yeah, I'll still be around.
Okay, sounds good. So if something comes up, just put it in over break. But Sean, as long as you're good to still go at 10:15, we'll stick to that schedule, and we'll let everybody stretch their legs a little, and we'll come back here at 10:15.
Let's see, I see a question here popped up from Brian. Let's see, could you run a net in price if we sold November cash bean price at a local elevator? Okay, to November future sell to, I'm not sure I understand the question exactly. You trying to compare strategies here? Yeah, I'd have to know what your basis is and stuff in November, but you talking about the strategy Frayne talked about where you sold local elevator and then bought a call? Yeah, I'd have to pull up. Let's see. Yeah, I'm not good at doing math in my head, so I'd have to put that into a spreadsheet and evaluate it. Let's see, $1 move up in futures. Let's see here. Okay, so let's see here. Okay, so futures are 1254. So if it went up to 1360. So you're talking about a fence there or whatever? Yeah, I'd have to, a spreadsheet I have right now just is this set up to evaluate buying puts and calls. I do have a spreadsheet, it's more advanced that could, where you can put in your positions and stuff, but I can't tell you right off the bat here. Let's see if you bought a, see an at the money put. Let's see if the price went up to 1350. I got 1360 here. Yeah, if you bought a 1260 put, that puts you up to 1159. Yeah, Brian, I don't think I'm going to be able to run that right now. I don't have my model I have here just for looking at buying puts and calls. I think you're looking at trying to do option sales. So naked sales on top of a cash price. Yeah, I don't think I can run that calculation right now. I'd have to have the, I can make available the spreadsheets I have here. But that's just too many, that's too much of a strategy here for me to be able to figure out right now. I don't have the stuff in front of me.
I see we had a couple questions come in over break. Thanks, Dr. Bullock, for trying to answer those. And then I saw he said he may contact you later. And so that's a good point. If you all have questions about this content or questions that you think may take longer than the capability we have today, you can send those to me and I can forward them on. Or if Dr. Bullock and Dr. Olson and Dr. Wilson share their contact information and are willing to help with those, we can do it that way too. But don't hesitate to reach out to me with those questions. Sean, do you want to try to pull up your presentation so we're ready to go?
Sure. Can you hear me all right?
Yes, we do.
Okay.
All right, I see your first slide, so should be good to go.
Okay. Are we ready to start then?
Yep, I will. It is 10:15, so I'm gonna reconvene us here. So we're gonna get started with Sean Holm. Sean is the oilseed product line manager at the Gavilon Group. So he is going to speak today with an industry perspective to some of the items that that we've covered today. So Sean, if you want to take that away, I'll hand the mic to you.
Sure. Yep. First of all, I want to thank the North Dakota Soybean Council and NDSU for inviting me. Just a little bit of a background on myself. I've worked in the industry about 22 years, and 10 of that was with ADM, and now about 12 years with Gavilon. I grew up in South Dakota in the Black Hills, went to USD, and started with ADM right out of college. Part of my time with ADM was in North Dakota at the canola crush plant in Valva. I was up there for a couple years, so pretty familiar with the area, and also being from South Dakota. So just want to thank everybody for joining and inviting me to do this. So here's our quick disclaimer. Basically, lawyers kind of make us put this in there, but basically all these views are not Gavilon. They're my own views, which I don't know if you'd want lawyers' views on the soybean market anyway. But so what we're going to kind of go through the presentation is just kind of go through, where we're at in the soybean market with price and how we've seen a significant increase and the reasons for that. So we'll go through both kind of a global look and then also kind of drill down into the US and what really matters to us from a pricing standpoint, but also the US balance sheet and kind of the drivers that are going on that are driving our bean prices here today. The first slide here is just kind of the big three soybean producers in the world. Everybody knows that the US, Brazil, and Argentina are the three biggest producers of soybeans. They're the three biggest exporters of soybeans. So in our view, obviously, if you can drill down and figure out these three main countries and then China from an import side, you have a lot of the soybean market figured out. You know, you can see from this slide, you know, how production over the last 10 years basically has went from, you know, 190 million metric tons between the three countries to basically 290 million metric tons. If you look at kind of the reasons behind that, obviously a lot of it is driven by Brazil acreage expansion and growth. You know, Brazil production over that 10 years has went from 70 million metric tons to, you know, right now the USDA is forecasting Brazil at 134 million metric tons. You know, if you look at the overall big three, you know, we've grown acres about 20, you know, over that time frame, that 90 million increase, you know, is a 52% increase from, you know, 10 years ago. Of that, probably 25% of it is acreage expansion, primarily led by Brazil. And then obviously the balance of it would just be the technology growth that we've seen in soybeans. And, you know, we've seen it in the US here, you know, where we've taken, you know, average bean yields 10 years ago from the low mid 40s to the low to mid 50s. So that's just kind of an overall production overview of the world as we kind of see it. You know, as we drill a little bit into the US balance sheet, you know, the first thing that we want to talk about is the crush side of the business. You know, we continue to see growth in crush from, you know, old plants being kind of rejiggered to, you know, expanding their crush to new plants coming online. There's a new plant just south of you guys that have that's come online here over the last year in Aberdeen, South Dakota. There's a couple in Michigan that have come up, and you know, right now, you know, in this past week, Cargill has made announcements that they're expanding 2 or 3 of their crush plants. There's an announcement for a new crush plant in Iowa. You know, so the industry continues to grow. You know, we've, you know, 10 years ago, we were crushing, you know, about 500 million bushels less than we are today. You know, so we continue to see this area of the balance sheet continuing to grow to meet domestic meal demand, to meet global meal demand from an export side, but also the domestic meal side, like we mentioned, that, you know, continues to grow at, you know, a 3 to 4% growth rate every year. You know, if you go back and look at kind of the big spike that we saw into the 17-18 year, where we took crush from, you know, 1.9 billion bushels to over almost 2.1 billion bushels. A lot of that was driven by the short crop that we had in Argentina that year and increased our exports for meal, and hence, you know, we saw a pretty significant increase in crush that year. And from then, you know, we've been able to maintain those exports. And then we've also grown with just our domestic growth on meal usage. You know, this year, the government's forecasting a 2.2 billion crush. Yesterday, we got an open number for the February crush that came out, you know, lower than expected, but I think the expectations were a little bit high considering, you know, the cold weather put a big hamper on, you know, crush the last half of the month, where we had crush plants running out of natural gas, so on and so forth. So, you know, the low number on NOPA yesterday, you know, it doesn't change our overall view on the total crush for the year, because we think it'll be made up here in March and April. You know, so our forecast on crush is right around the government number at 2.2 billion bushels. If we move to the next slide here, you know, what kind of drives crush primarily is our grain consuming animal units. You know, if you look at the overall crush, you know, about 73% or 75% of the meal that we produce in the US from crush goes to domestic feed of animals. And then about 25% of the balance of the meal that's produced goes to the export market. So the domestic usage, you know, driven by, you know, hogs and cattle as of late have been, you know, increasing on the growth side. Poultry, I think for the first time, we're starting to see things kind of tail off and have kind of lower expectations for growth from the poultry side. But overall, we still see very, very good domestic meal demand led by cattle and hogs. This is just a chart when you look at domestic meal demand in the US, total domestic meal demand. You know, as I said before, it makes up about 75% of the total meal that we produce. You know, but essentially, you know, on this side of the balance sheet for meal anyway, when we're looking at soybean crush, you know, we continue to see this area growing at about 2 to 3% a year. You know, this year is going to be a little bit dicey, and maybe even into next year, just with the limiting supply that we have on soybeans and the tight balance sheet that, you know, everybody's kind of forecasting for the 21-22 balance sheet. You know, the only thing that is going to limit the meal demand side is going to be the supply of soybeans. And, you know, this year with the carryout that we have, we do think that, you know, the reason we probably won't see this 3 to 4% growth rate is because of the limited crush that we're going to have because of the supply of soybeans. You know, before I move into kind of the export side of the balance sheet for the US, you know, the one thing that's really changed, and I don't have a chart on it, but is the demand for soybean oil. You know, we typically, you know, export, you know, 2.2 to 2.7 billion pounds of oil a year. We typically are using about 8 billion pounds of oil for biodiesel usage. And we have about 15 billion pounds that we use for just domestic usage, whether it's food or so on and so forth. The one thing that we've seen change here over the last year is the green diesel side of things. You know, there's forecasts that, you know, the capacity for green diesel, which we have a new plant in Dickinson, North Dakota that's up and running right now. But the green diesel side of things, you know, the forecasts are out there that, you know, we could see a 2 to 3 billion gallon increase in green diesel demand. And if you want to just kind of do that on the back of your envelope there, I mean, for every gallon of diesel, it takes about 7 to 8 pounds of feedstock to make a gallon. So, you know, it's a pretty significant change when you're talking about 2 to 3 billion gallons. You know, that's equivalent of, you know, 14 to say 15 billion pounds of feedstock to feed this kind of new demand that we have coming online. We know that it's going to take away a little bit from the kind of old school biodiesel. But at the end of the day, not very much. But at the end of the day, we are going to see a pretty significant change in the balance sheet. And the USDA is going to start to break it out. You know, today they break out exports, biodiesel, and kind of food usage. They are going to start breaking out kind of the green diesel from the food category that they put it in today, because it's changing pretty dramatically. Let's move to the kind of export side of the balance sheet. You know, this year, you know, we've seen a significant increase in exports for beans out of the US. A lot of that is driven by, you know, ASF somewhat getting cleared up in China. A lot of it's driven by kind of the phase 1 trade deal. But, you know, we've seen our exports go from, you know, 1.7 billion bushels to, you know, the government's forecasting us today at 2.25 billion bushels. You know, of that 2.25 billion bushels, we're estimating that close to 2 billion of it's going to be exported in the first half of the year. So, 2 billion of the 2.25, that only leaves about 250 million bushels to 300 million bushels that need to be exported the balance of the year just to get to the government 2.25 billion export estimate. Right now we have about 98% of that sold and already on the books. So our forecast for bean exports would probably be closer to 2.3 billion bushels, which even tightens the balance sheet even further. And we've shipped about 89% of that 2.25 that the government's forecasting today. We've shipped about almost 2 billion bushels. So we've seen a dramatic increase. Obviously it's impacted our balance sheet tremendously and therefore impacted flat price of soybeans, basis levels of soybeans, and kind of the spreads that trade on the futures market. So it's pretty significant. Basically to hit the government number, I think we only need to sell approximately 50,000 tons of beans a week just to hit their number. We always carry over or roll over, probably 1 million to 2 million tons. So, we're forecasting that, to hit kind of our estimate, you got to sell between 75 and 100,000 ton a week. And, the last few weeks we've been selling, somewhere between 300 and 400,000 tons. So our pace of exports continues to be very, very good by kind of what we call our captive business. And that's going to be a lot of the Japanese, Mexico, Indonesia, a little bit of Egypt business. So we continue to see those guys in our Caribbean business in the market, and they'll be in our market, kind of all through the summer. When we look at kind of the overall landscape of soybean exports, obviously, North Dakota beans primarily flow to the PNW. These charts just kind of break out PNW exports versus Gulf exports. So in the first half of the year, we had a record year, 488 million bushels shipped off the PNW the first 6 months. We had almost 1.2 billion bushels ship out of the Gulf the first 6 months. And, you can see by the chart there, those are dramatic increases year on year. Typically we figure that out of the total exports, the PNW is going to ship approximately 25% of the U.S. exports, and the Gulf ships about 60% of the U.S. exports. One thing to keep in mind when you're looking at 488 million bushels of bean exports going off the PNW the first 6 months of the year, North Dakota grows about 175 to 200 million bushels. South Dakota grows about 225 million bushels. So between North Dakota and South Dakota, we grow about 400 million bushels, and you can see that we exported 488 million bushels the first 6 months of the year off the PNW. Nebraska ships beans to the PNW, Minnesota ships beans to the PNW, Iowa will ship a little bit of beans to the PNW, but at the end of the day, you can say that every bean that's grown in North Dakota, every bean that's grown in South Dakota, we essentially shipped for exports off the PNW the first 6 months of the year. When we're looking at kind of the global picture of soybean imports, obviously China is the biggest driver of global soybean imports. They import about 65% of the world's soybeans, which is pretty significant. Up until ASF and trade war, whatever China's kind of GDP was, that's kind of what you could plug in for their growth in soybean imports, somewhere between 6 and 8% a year, and basically somewhere between 5 and 8 million metric tons a year of growth from China. They continue to move their diets to higher protein type diets. And, obviously the world soybean exporters are beneficiaries of that. You go back to 16, 17, we're at 93 million metric tons of imports for China. 17, 18, in the calendar year of 2018, it's kind of when the trade war started, and U.S. exports kind of shut off to China. That's why we saw kind of a flat year on year. And then obviously in 18, 19, not only did we have the trade war impact, but we also had the ASF impact. And, China bean imports dropped down to 83 million metric tons. We got through trade war, we got through ASF, we bounced back close to 100 million tons a year ago. This year, the government's forecasting 100 million metric tons for China. Our forecast is probably closer to 103 to 104 million metric tons. And then in May, we'll start to get new kind of global balance sheets for new crop. And, I would say that, our estimate, there'll be somewhere between 105 to 110 million metric tons for the 21-22 year. When we look at non-China, we continue to see non-China growth at, somewhere between 2 and 3% a year. And, you can see that in the chart where, it's not the Chinese growth, but, we continue to see a 1 to 3 million metric ton increase year on year on average for non-China type destinations. This is just an overview of kind of where the U.S. balance sheet is today. You can see up there that we have kind of our analog year from 13-14, where we had a 92 million bushel carryout or a 2.6 stocks to use. This year, the government, is forecasting 120 million bushel carryout, 2.6 stocks to use, same as 13-14. Obviously demand has grown tremendously since 13-14. Hence the 120 is equivalent to, the 2.6 stocks to use carryout that we had in 13-14. Probably the biggest differences that we have, or I have, in our balance sheet versus the government balance sheet is that, we're forecasting, a 25 to 50 million higher export number than the government. We think crush is pretty much in line, maybe has a little bit of downside to what the government's forecasting. But we think that the import number needs to be, somewhere between 50 and 75 million bushels just to kind of maintain this tight carryout level that we have. When we imported 72 million bushels of beans in 13-14, about 30 million of that went to the East Coast between Wilmington and Norfolk. And then we had about 10 to 15 million bushels that came into the Gulf that fed crush plants that are on the river. So, we look for similar type setup on imports and distribution just to maintain this very, very tight carryout. Most of those imports will come from Brazil, as they're pretty much the only one that could be priced to export beans to the U.S. But that's kind of yet to be seen. We really haven't seen it price into the market too much yet as far as, any significant imports. We always do about 20 to 30 million bushels out of Canada. But, the balance is going to have to be South American supplies. So we go from the U.S. balance sheet to kind of the global balance sheet on where we're at on soybeans. you know, the biggest thing that everybody needs to keep in mind is, you know, not only do we have a very tight U.S. balance sheet, but we've tightened global soybean stocks significantly. You know, the government's forecasting 84 million metric ton carryout, kind of in the mid 22% stocks to use. You know, over the last 6 years, you know, this will be the tightest kind of global stocks to use that we've seen. You got to go back to the 11, 12 and 12, 13 years where, you know, we had similar type setups for tight stocks to use globally. You know, today when we look at it, you know, we would say that, you know, the global carryout's probably somewhere between 80 and 82 million metric tons, so even a little bit tighter than what the government's forecasting, led by a little bit higher Chinese demand. But also, you know, we feel like, you know, from a production standpoint, the government's probably pretty close on Brazil at 134, with Argentina at 47.5. We feel like there's somewhere between 2 to 3 million metric tons of production downside versus what they're forecasting today. So everybody, you know, wants to talk about China and their demand for beans, and we've seen a, you know, significant increase. We went through the phase 1 trade deal signing last January, where they committed to take $36.5 billion worth of U.S. agriculture products in 2020 and $43.5 billion in 2021. When you add everything up for 2020, they ended up just shy of 30. You know, I don't think anybody really expected them to get to $36.5 billion worth of imports. And then we had COVID hit, you know, so I think there's a little bit of leeway there. But, you know, at the end of the day, you know, China basically ended up on total US dollar imports very similar to, you know, the 12, 13, 14 years that you can see on the chart. When you break that out, you know, probably half of that is going to be soybean shipments to China, and then the balance would be everything else from corn, wheat, pork, ethanol, so on and so forth. You know, the one thing to note, you know, with the increase in price in soybeans that we've seen, you know, China's going to take about 35 million metric tons of beans out of the U.S. this year. You know, that 35 million metric tons, you know, back before we had this price run up, you know, is equivalent to about $15 billion. And now with the price run up that we've seen, you know, that equivalent 15 billion is about $21 billion today. So, you know, they don't have to increase the amount of beans that they take or the amount of stuff that they take just from the price increase. You know, we've seen, you know, almost a 30% increase in prices across the board. So, you know, 30% increase on top of the 30, you know, they could get to $40 billion pretty close with, you know, take an equivalent amount of stuff out of the US for 2021 as they did in 2020. So we looked at, you know, the US balance sheet, we looked at the global balance sheet, you know, and not that everything is kind of set in stone, but, you know, those balance sheets are close. You know, the market on March 31, we're going to get our first kind of acreage intention. The market is going to start to focus primarily on the new crop. You know, we still feel like there's a lot of volatility left in the old crop price and balance sheets, but, you know, the market in general is going to start focusing on new crop and, you know, trying to figure out how do we solve this year's tight balance sheets and go into next year, you know, where are we at? And, you know, the price that we're seeing on new crop, both corn and beans, and with the weather setup that we've had maybe prior to the last week or so in the forecast that we've had, the price, that we see today, obviously are very good prices. But at the end of the day, we need to make sure that, the U.S. farmer plants as many bean acres and as many corn acres as possible. And, the last 2 years we've fought, high prevent plant acres. A month ago, I think the market was pretty comfortable with us having a very low prevent plant acreage base, which would in turn, allow us to plant a record corn plus bean area. The weather has changed a bit here recently, and the forecast is probably a bit wetter than what people would like. But, at the end of the day, we're still in the need of, I think the market today is estimating that we'll see corn areas somewhere between 92 and 93 million acres, and bean acres somewhere around 90 million acres. That would be a record corn plus soy area. The bottom line is, we need to make sure that we plant a record corn plus soy area. And, if weather continues to change and maybe moves a little bit more to the wetter side that we're seeing kind of in the southern corn belt and the delta areas, those guys obviously have a lot more time to get stuff planted. But, we feel like, there probably needs to be a little bit more premium in this market to make sure that, just in case we end up with higher than expected prevent plant acres. March 31, is a big crop report. It gives us updated stocks, and it gives us kind of the first glimpse at farmer surveys and what their ideas are on what they're going to plant for the next year or plant this spring. So it'll be a pretty important crop report. We expect a lot of kind of volatility around it, and it'll be one that kind of everybody's watching. So we looked at kind of the U.S. acreage base. This is just kind of a background on what we continue to see out of Brazil and the acreage increase that we see year on year from them. We saw in one of the first charts that, we've seen Brazil production over the last 10 years go from 70 million metric tons to almost 135 million metric tons. They continue to expand new area every year. That expansion is slowed just because you're running into the point where you can only expand so much now. And, we expect, the growth rate to continue at 3 to 4% a year. But it just shows a significant change that we've seen in kind of global production from Brazil. So this kind of last chart kind of sums up, what we see year on year from a global protein demand standpoint. Global meal consumption, rises, every year by 3 to 3.5%. To put it kind of in perspective, 3% rise in global meal usage, if you're figuring a 325 million ton base, that's about 9 to 10 million tons of meal a year, or about 13 million tons of soybeans a year that we see increase in demand. 13 million tons is about 450 to 500 million bushels. So, this acreage increase that we keep talking about and this technology increase that we talk about, we need that to just kind of make sure that we're meeting the demand from kind of the global protein usage standpoint. It's maybe slowed a little bit over the last couple of years just with the issues that we've had from ASF and COVID. But we continue we continue to estimate that meal consumption globally will increase, close to 3% year on year. So hence, just the demand for global acreage expansion, technology to continue to improve. None of that happens at a whole lot cheaper prices. It takes higher prices to pay for better technology. It takes higher prices to, pay for acreage expansion, or it takes higher beans versus corn prices to steal, feed grain acres and move it to oilseed acres. Just kind of a wrap up on kind of where we see, the old crop balance sheet and old crop prices kind of balancing out here the rest of the year. If you look at the analog year that we had noted on the US balance sheet from 13-14, old crop futures at $14, we feel like, we probably have upside to somewhere between 15 and 16 if you look at kind of similar analogs. But the important thing is we're getting through the old crop balance sheet, and we estimate farmers have sold, probably close to 90% of their crop already. So the big one is the new crop balance sheet. We need 90 million acres of beans with the demand expectations that we have just to kind of maintain a pretty tight balance sheet. And that's before we even get into any sort of weather type issues this summer. So, with new crop futures today at 12.40 and old crop futures at 14.20, our expectation for new crop to make sure that we get the acres planted, maybe to give us some little bit of a premium for weather, any sort of weather issue that we might have this summer, is that, new crop futures somewhere between $12.50 and $13 is probably a good kind of price target area to start off with here. As we move into spring and summer, and depending on obviously the weather and what its outlook is, but we'll kind of take our price targets and move it around with kind of the weather forecasts that we see changing, good or bad. So but initially, we still see soybeans being pretty well supported. The biggest risk that we have going on right now in our markets, obviously ASF, there's still headlines kind of every day that it's maybe coming back a little bit in China. The market continues to talk about inflation. We think that that's supportive for commodities, but if that kind of narrative changes, would be a little bit negative to our markets. But, when you just look at kind of the balance sheets, which we look at every day, things, look to be, fairly supported. So that's all I have from slides and presentation. If there are any questions, I'll be happy to answer those.
I do see one, excuse me, in the queue, Sean. It says, I believe, given the negative supply-demand ratio, what price will it take to ration demand for soybeans?
Yeah. Earlier we talked about, old crop bean price analogs, somewhere between $15 and $16 a bushel. There's a combination of things that have to happen. Either price will have to go higher than that, or we'll have to figure out a way to import more beans than what is forecasted today. But that's why, conservatively, we feel like old crop bean prices, somewhere between $15 and $16 a bushel will start some of that. And it also will allow, basis levels to kind of price maybe a little bit higher imports than what the market has or what we've done already.
Thank you. Any other questions for Sean? I've got one here. If wheat doesn't move up, won't it shift to feed?
Yeah, yeah, we've seen increased wheat feeding in the U.S. You know, and it continues to kind of price itself in the market. The corn market is trying to figure out, you know, what type of carryout we have, because, you know, there's, you know, today we had a flash to China for corn exports, and, you know, nobody knows exactly how big that program is and how tight or how not tight the corn balance sheet is. So the corn market's being pretty protective on the amount of feeding, and it's a, you know, the price is allowing higher wheat feeding right now, and we're continuing to see that. The wheat balance sheets, you know, are okay this year, but, you know, it starts to impact kind of the new crop wheat balance sheets a little bit more significantly. But for old crop, there's plenty of wheat around to feed, and, you know, till we know what we have with the corn balance sheet, I think we'll continue to see, you know, wheat feeding in the U.S.
Jenna, if I can add to that.
Yes, please.
So one of the challenges we have, especially in the hard red winter wheat market, which is the primary, right now, kind of the primary source for wheat feeding, you're absolutely right. As corn prices go up, the winter wheat needs to keep a premium to that corn base, so that not too much of it slips, of the milling wheat slips into the feed ration. The challenge, though, is as corn prices go higher, U.S. winter wheat prices go higher. Now we start pricing ourselves out of the global market. And so if you were to look globally right now at U.S. export bids out of PNW for hard red winter wheat relative to what you could get out of, even currently out of the Black Sea region or out of Argentina, you know, we're not priced competitively. And so that's the challenge the wheat market has, is how do you balance this? We have to keep prices high enough to get it out of the feed market, but yet maintain that base we have in the international export market. And it's struggling. It's struggling right now.
Yeah. Yeah, the global freight rates have changed dramatically over the last month or two, and it's caused a lot of, I mean, there's a lot of unusual, like, freight rates out of the U.S. are as high as we've seen them in a long time, and that's definitely impacted our ability to export wheat as well.
If I can pull this up really,
Sure.
quick, I'll see if I can show a graphic.
Yes, please do.
Let me just click. Let's see, Australia. So let's see if I can do this really fast on the fly. It's always a challenge.
Yeah.
yeah. Right. So let me pull this over here real quick. This is out of, again, what some of the stuff that we've got in the trading room. Let me make this a little bit bigger. So this is ocean freight rates from different locations into North Asia, just as a reference point. So I tried to pull up several different locations. You got from Brazil, PNW, US Gulf, Argentina, Black Sea, and Australia. And the whole point is that these freight rates do tend to, for specific routes, obviously they're different, but what Sean was just saying, you can see that over the last month or so, a couple of months actually, as we look at the freight rates over here on the far right hand side, they're starting to come up. And again, this is for bulk grain. You know, they're all going up, and as those freight rates go up, the relative profitability of buying or procuring from a different locations does change. And that rate increase is substantial. It adds up, especially from a buyer's perspective. So I'll stop sharing so we can keep our discussion going.
Yeah, it's, you know, just US Gulf freight to China. I mean, it's up 55 cents a bushel, and, you know, trying to pass that on to the buyer is pretty difficult.
Yep.
Obviously right now don't have the beans to export for the balance of the summer, but, you know, if these freight rates continue, it'll put a little bit of a hamper on new crop exports.
Any other questions for Sean? There was one about conversion of pounds of feedstocks to bushels of soybeans and green diesel, but I messaged, that was kind of a math question, and so I messaged that answer. But if that did
Okay.
not answer that question, please retype that into the Q&A function.
Okay.
Any other questions? I don't see any. We've got, as I said, Dr. Olson and Dr. Bullock are still on as well, so I would open question period up to everyone if everyone would be amenable to that.
So I actually have one for Sean, and I'm probably putting you on the spot here, but coming back to Jenna's question about the green diesel and in particular what's happening in California and that potential demand base, I know that's really putting some ripples into the soybean oil market. And again, changing the margins when it comes to crush demand. What do you see happening in there? I mean, look into your crystal ball. You follow that market a lot closer than I do. What is your crystal ball view of that potential biodiesel, the advanced biofuels use for diesel?
Well, if you look at the plants that are scheduled to come online and the ones that have come online, it's pretty significant over the next 4 to 5 years, where you're going from a 500-600 million gallon base to over a 2 billion gallon base for green diesel, right? So, when you're talking every billion gallons is about 7 to 8 billion pounds worth of feed stuff. And, it's very significant when you're talking about, on just the soybean oil balance sheet alone. I mean, we only produce, 25 billion pounds a year, and you're talking about increase in, somewhere between 10 and 15 billion pounds of feedstock usage, and typically 50 to 60% of that is bean oil. So, we've seen significant changes in crush margins over the last month, and a lot of it's driven by oil basis, and typically oil isn't the leader of a crush margin when you're talking about soybeans, but that's changed pretty significantly. So when you're talking about oil basis going from option to 500 over to 1,000 over, every 100 points is about 10 to 11 cents in crush margin that you're adding. So, when we're talking about our tight balance sheet, when you're improving crush margins, it's hard to ration crush to, maintain a pretty tight carryout. So, something has to change a little bit. And, the basis on beans has gone up, the basis on meal continues to be weak. So there's kind of offsets there a bit, but, the oil revenue driver of the crush margin is, say it's increased from 35% to 40 to 45% of the revenue, which is pretty significant. And it's primarily driven by the green diesel side.
Yep.
So do you see with that demand, so the Soybean Council works with the National Biodiesel Board on quite a few projects, and they talk quite a bit about as this demand goes up and up and up, and we see tight soybean supplies, they're looking at other feedstocks as well. And one of their kind of solutions is this pennycress and this cover crop that you plant in between soybeans and corn, and they can see that being crushed for oil. Do you guys, it's probably not far enough down the pipe that you guys are thinking.
It takes a long time to build infrastructure and capacity, right? So it's not a short-term fix. It's nothing that'll fix anything in the next 3 to 5 years. But I don't know enough about it to talk a whole lot about it. I just know when you're talking about infrastructure changes to that magnitude, it takes a lot longer than what you would expect.
Yeah.
So I don't see a big impact. You know, the easier impacts would be, you know, other veg oils that can, you know, kind of meet this demand and have pathways for it. But significant changes like that, they take a lot longer than expected.
Sure. We did get another question here. It says, so in the next 4 to 5 years, we'll easily be seeing more domestic use than exportable whole soybeans to China. So will we start to see more domestic demand for soybeans than we have within the next 4 to 5 years?
Well, we've already kind of seen it. I mean, right now we're forecasting 2.2 billion bushels of demand for crush and 2.25 from the government on exports. Yes, we will see that crossover as we continue to see, you know, the U.S. maybe be a little bit bigger part of kind of global meal exports, but also just driven by domestic protein usage. You know, how does it change the flows of, you know, right now, kind of northern beans, you know, we've added a crush plant in Aberdeen. You know, there's expansions kind of in that draw area, but, you know, for the most part, most of the crush expansion would be hurt maybe more river tributary beans. So we don't see the change in flows on P&W stuff, but, you know, it definitely would impact the flow that goes out of the Gulf. So, you know, maybe you shift the P&W exports at 25% share to 30 or 35% share, but, you know, we're getting there. I mean, it's, you know, this year, you know, if we wouldn't have seen kind of the phase 1 impact of beans, I don't think, you know, we probably would have had a higher crush in exports this year, but we do look for that to continue to gradually move towards a higher, similar to what we're seeing on the ethanol side, right? You know, ethanol, we use 5 billion bushels of corn for ethanol, and we export about 2.5 billion bushels or whatever, but I don't think we'll see you know, that big of a gap between bean exports and bean crush, but, you know, I look for them to be, you know, within 50 to 100 million bushels of each other for the next 3 to 5 years at least, because we do see continued growth in exports as well.
So Sean, you're thinking right now that most of the additional crush capacity will be either existing plants that expand, or if there are new plants, it will likely be more in the traditional crush area of the U.S. rather than necessarily an expansion of the crush industry north?
I mean, we don't have crush plants, so, and we don't have plans to have crush plants, I can tell you that. You know, the most recent new plant is in Aberdeen, South Dakota. It's hard to say that, you know, any new plant expansion won't be in North Dakota or South Dakota, because the likelihood is higher that it would be, but you know, so I said that I'm more 50-50 on it. I don't, you know, I don't see a big, I think what's going to happen is we're going to see more kind of expansion from current plants than brand new plants.
Yeah.
It's a lot easier and a lot cheaper to do that.
Yeah, I guess that was probably the base of my question, is that
Yeah,
most of the growth will likely come from existing plants adding capacity and adding their abilities rather than necessarily brand new greenfields facilities coming up.
yeah. And there's an announcement by Cargill a week ago that, you know, they're doing just that. They're, you know, putting a bunch of money into existing plants to expand them.
Yeah. And,
You know,
and part of that
breaks my heart, Frayne.
So Sean, as you know, you've been up in this area. We're desperately crying for a new plant to be located here in the state. But
Yes.
you know that, and I think to reiterate, I guess one of the things I want the audience to start thinking about is you know, anytime that you start looking at, and again, first off, major expansion into a new, what we call green fields or brand new plant facilities, you know, as you mentioned earlier, along with that has to come the supply chains, not only for the inbound product, but also for the outbound product.
Yeah.
And so when you think about the additional cost of putting in a brand new plant in a brand new location versus taking an existing plant, being able to expand the capacity because the flow of product is already there. Just on the margin, you're expanding it rather than trying to come up with something new.
Yeah.
And anytime you talk about those new developments, it just takes a lot more time and effort and cost to be able to get that to work smoothly.
Yeah. Yeah. Well, and the one thing I'll say, you know, Gavilon does not have crushing plants and has no plans to have crushing plants. So, you know, when you talk about expansion, you know, I will be the last one to know about it because we're not in that market. So
Fair. Very good discussion. Any other, oh, I see a question again. It says, we'll need to see planted acres of soy at 90 million plus every year just to keep up with exports and domestic usage. And that is a question. Do we need to see planted acres of soybeans at 90 million plus every year in order to keep up with exports and domestic usage?
yes, absolutely we do. I think eventually we need to start stealing from corn acres, and I don't know how we're going to do that, but you know, everybody's talking about electric vehicles and the impact on ethanol and so on and so forth. So I think there's opportunities there possibly, but yeah, I mean, we need to increase global area by, you know, 8 to 12 million acres a year just to meet the 3% growth rate that we continue to see in protein demand. And whether it comes from, you know, right now, you know, Brazil and the US are the two main areas, right? So we will have to continue to see area in the US grow. And the only way to get that to happen, get farmers away from like a normal rotation, is, you know, price versus corn will have to, you know, reflect that. So yeah, I mean, you're kind of getting to the point where there's only so much area you can increase, and there's only so much area in Brazil you can increase. You know, you got to hope for, you know, kind of a technology leap or something like that, where, you know, the technology growth is going to have to be bigger than the area growth to keep up with demand. You know, because we don't see protein usage globally, you know, backing off from, you know, at least 2% a year, but continuing to stay at 3 to 4% a year.
So if I can also jump in and add, you know, Sean is right. We're at a minimum, we've got to hold acres and hope that the yield growth rate is able to compensate in part of that. But again, we get yield growth rate in both soybeans and corn. So this battle or this competition is going to be really interesting to watch. The one thing I also want to add to that, just for discussion, that we do have other growth areas globally that can move into and expand both corn and soybean production. And the area I'm thinking most specifically about is in that Black Sea area, because the Black Sea weather conditions are not that much different than what we see in North Dakota and South Dakota. And so the ability for them to either expand acres or to be able to become more productive in corn and soybean production, I think is a very viable alternative. And if you look at the numbers right now, Argentina is the Ukraine is the fourth largest exporter of corn. And both Ukraine as well as Southern Russia has the ability to expand corn and soybean production. Now, again, technologically, when it comes to yields and yield potential, they're obviously much lower than we see in Brazil and the US, but there are other growth areas we can't ignore.
Yep, absolutely. The world needs it for sure.
Yep.
I just saw that Bill is on as well. Like I promoted Bill to panelist. So Bill, if you had anything to add or question to ask, you have that ability now, not to put you on the spot. Otherwise, I don't see any questions.
Sean, I'll just make a comment.
Yes, please.
I was on all the time, but I wasn't called a panelist, so I couldn't say hi to you. So many of our students are down there with you, and we want to
Yep.
thank Eric Berge, but also Andy Knudsen and Ryan and Nate
Yep.
Moody, and all those guys are all students of ours. So that's why we like having Gavilan people here.
Yeah, we're represented very well from North Dakota State.
Does Nate Moody make you watch football?
He does, and Andy. I mean, they all do. I went to USD, so I have a hard time talking about football with North Dakota State people, but you know, it's pretty fun banter.
Yeah, great. Well, I wanted to at least greet you, so thanks.
Okay, thank you.
Yep.
All right. Well, Sean, we really appreciate you being here and putting in the time to talk to us about this. We had some
Yep.
great discussion. You had a lot of great data, so we appreciate you sharing that with us.
Yep.
With that, I think we are ready to excuse me, close the seminar series. I'll remind everyone these are recorded. We will be putting these recordings on our website. You will get them in an email link. That email will also contain a link to a survey. If you would please fill out that survey, it helps us to improve these going forward and to come up with new events like this that meet what you all are looking for. So with that, thanks for being here today, everyone. Hope everyone has a productive and safe planting season. We'll see you.
Thank you.
Thank you.